Open a minute to go until the start of cash equities trading. Here are your headlines. Amazon fails to deliver. The e-commerce giant plunges post-market after missing estimates for the first time since 2018. US futures slide. China saps risk appetite in Asia as investors dissect a week of crackdowns. We'll dig into the implications for global markets. Plus, NatWest plans a buyback after reversing more of the bad loan provisions that it took early in the pandemic. We've been speaking to the CEO, Alison Rose. Good morning, everybody. Welcome back to the European Market Open, the second hour of the programme and the first hour of European equity market trading, of course, here for Europe this Friday. So European equity market futures pointing downwards, down by 0.6% on the Euro Stoxx 50 futures, DAX futures and FTSE futures under pressure, as you can see, down by 0.8%. And the earnings stories have not been all that disappointing today, perhaps, but it's certainly the drag coming through from the Asia session that is casting some weakness here. Also, the drag coming through from the US session and the after-hours earnings report from Amazon. All of that adding up to two things to worry about: the future of opportunities to make profit in China and the future of growth for tech businesses. Are we past that peak during the pandemic for the tech story? So all of that very much at the center of things as we open up these European equity markets. And just see, we get some Spanish second quarter GDP numbers coming through. So Q2 GDP expanding by 2.8% quarter on quarter. The estimate was for an increase of 2.1%. We'll return to some of the growth narratives that we've had this week shortly. That's the Spanish number coming in much better than expected. Also, we've had the US number, of course. That didn't come in better than expected, but there were some bright spots maybe around the consumer. So in terms of the focus on markets, let's get to that now. European equity markets opening to the downside, as you can see. So down by 0.8% on the FTSE. The Spanish IBEX and the French CAC 40 are all opening lower. So European stocks have been benefiting from a cascade of corporate earnings, but that's not necessarily what's driving stocks this morning. The European stock markets have been climbing, though, in recent sessions, climbing 16% this year, and the European stocks are at a record high. Let's bring into the conversation our next guest, Bob Parker, Quilvest Wealth Management, who is with us. So we've been on a positive journey for European stocks, Bob. Good morning to you. But things are a little bit more challenging this morning. We're having a bit of a difficulty making any progress. We seem to be caught between these two different global worries: profits in China and technology stocks in the United States. How worrying are these themes for you? Because they seem to be knocking European equity markets this morning.
Well, I think, first of all, let's start on China. And there are really, I think, three areas of concern there. The first area of concern, which you've documented very well on Bloomberg, is the rising corporate default rate and the uncertainty of the outcome of debt restructuring for a number of companies, notably Huarong, Evergrande, and also Suning. And default rates in the first half of this year in China were at a record high. Risk factor number two is obviously geopolitics, and the latest area of concern there was the criticism of potential Chinese cyber hacking of the Microsoft exchange. And then, obviously the third area, as we've discussed, is regulation. And it's not just regulation on the tech sector. It covers education. It covers, will China allow further IPOs on New York exchanges? So increased regulation, geopolitics, and corporate defaults. And those factors are not going to be resolved in the near term. And therefore, I think the first conclusion is that China will act as a sort of a negative factor on global markets probably for the next month or two. Is it too early to go back into Chinese markets? I think a word of caution. I think there is going to be a stage, possibly, in the fourth quarter, where capital flows will go back into China. So that's factor one. Factor two, on the US, let's not forget that the most expensive sectors in the States are the IT sector and consumer discretionary. And it's not just a question of valuation. If you look at the next 12 months, earnings growth in the States looks good at 18% over year on year for the next 12 months. But the IT sector earnings growth is probably going to be less than that. And one has to ask the question with Amazon: have they reached the point of market saturation?
Right, saturation, or at least the peak of their sort of pandemic performance, Bob. I mean, we should maybe have seen that coming, should we? I mean, should we have been disappointed? Should we really be disappointed when companies such as Amazon don't do quite as well on the other side of a global pandemic that have driven their business so strongly? I mean, even the companies suggesting this is a good development, that people are getting out of the house more and able to go shopping for themselves.
Well, I think sort of two observations. Hopefully we will move from this period of economic and market shock in 2020 to, in 2021, this period of economic and market recovery, to the next 12 months I call sort of an era of economic and market normal sort of situation. Now, if we do move back to a normal situation, clearly those companies which have benefited from the shock that we had last year, their outperformance will reverse. And arguably, that's exactly what's happening with Amazon. I think the second factor is that if you look at the outlook for corporate earnings over the next 12 months, both in the States and in Europe, and for that matter, certain key markets in Asia, such as Japan, the most pronounced corporate earnings growth is actually going to be in areas like industrials, materials, and energy.
Okay, so that sets my next question up nicely then, Bob. What messaging have you been taking away then from the earnings season here in Europe? Clearly, one of the big themes has been dealing with cost pressures and pricing power and ability to pass those costs on to those along the supply chain. That's something that stood out to me. Which are the themes that stand out to you from this earnings season, Bob?
Well, I think the first point to make is that we've had a record recovery in corporate earnings growth in the Eurozone in the second quarter. And year on year, corporate earnings, probably due to base effects largely, are going to come out at sort of over 100%. And as I mentioned earlier, I think the strongest growth is going to be in areas like industrials, energy, and materials, and to some extent consumer discretionary, as consumer spending, and we've seen that clearly in data in May, June, and July. In most European economies, consumer spending has picked up after a very weak start to the year. So peak earnings growth in the second quarter, that earnings growth is going to slow down. But if we look at the next 12 months, I think Eurozone corporate earnings growth is going to be close to 25%. And that's higher than we are seeing in the States or a number of Asian markets such as China and Japan. So the underperformance that we have seen in Europe versus the States, I think that over the next 6 months or so, that is going to reverse.
Okay, Bob, stay with us. Bob Parker, Quilvest Wealth Management Investment Committee member and regular guest on the programme. He'll be back with us shortly. Coming up here on the European Market Open, the world's biggest ever vaccination drive hits 4 billion doses. We'll discuss the risks from the Delta variant, though, and the recovery from the pandemic. Next, this is Bloomberg.
up to Maine and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astercoma carinata.
I nailed it.
It's not thera, whatever. Astercoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Welcome back to the European Market Open. 9 minutes into our trading session here in Europe, and European equity markets moving to the downside. Let's just pause that thought for a moment, though, and take you to some of the legal system developments that are playing out in Hong Kong. The Hong Kong man at the center of the new security law, of course, he's the first man to be convicted under it. He has been jailed for 9 years, and we were expecting to hear today from the authorities in Hong Kong, from the court in Hong Kong, as it was set to sentence this first person convicted under the national security law that has been imposed by Beijing, of course. The hearing is being closely watched by many people, by many pro-democracy activists, of course, because many of those activists are awaiting similar trials. So this will give us a sense of just how strict the national security law is in its application. And we do know that this person has been jailed for 9 years. So Tong Ying Kit, a waiter, faced up to life in prison after being found guilty of incitement to secession and engaging in terrorist activities. That was the conviction that we heard about earlier on this week. Now we know how long he will be jailed for. Let's take a look, though. Back to the markets. Let's take a look at what is on the move this morning. And we have an upside story to tell in the auto space. Renault moving to the upside. Not too concerned, the management says, about the latest sales figures for the Zoe brand, but that stock up by 3.2%. And the story around Renault, essentially, they have been, just like many other companies in this space, talking about the chip shortage, the chip crunch, and they see it capping their output and margin recovery. But despite all of that, the stock managing to make some progress, up by 3%. UniCredit also really in focus today, this as a result of their earnings, but also because of the acquisition that they're making, perhaps. So that stock up by 5.2%. We knew that discussions have been taking place, and they are in discussions about Monte Paschi. So an all-Italian affair, a government-favoured solution to what to do with Monte Paschi, which has been an issue for them since the great financial crisis. And it seems as if Andrea Orcel, who's new to UniCredit, is making one of his much famed M&A moves on that front. Let's also tell you what is going on at another corporate. If we move on to the last one on the list, you can see that IAG is down by 2.9%. We've had a mixed set of results coming through and guidance, I suppose, coming through from the aviation sector. Air France perhaps a little more optimistic. IAG saying it operates in a different regulatory space and in different markets to Air France. And you can see that the market is down today on that stock. That stock is down by 3.2% or so. Let's get a Bloomberg Business Flash. Here's Annabelle Drewlers.
Thanks, Anna. Well, NatWest Group says it aims to distribute a minimum of £1 billion a year from 2021 to 2023. That's via a combination of ordinary and special dividends. That's after the UK's biggest corporate lender reversed more of the provisions it took early in the pandemic, helping it beat earnings forecasts in the second quarter.
Strong performance across all of our businesses, driven by an increase in lending with mortgage growth. The mortgage market here remains very strong. And as we come out of lockdown, consumer spending is starting to recover back to pre-COVID levels. What we're seeing is, very low level of defaults. Businesses have been remarkably resilient. There's a lot of support still in the economy, but as we come out of lockdown, confidence is coming back.
Trading app Robinhood has had the worst ever debut for an IPO of its size in the US. Shares quickly slipped below their opening price of $38, ending the day down almost 8.5%. The trading platform had set aside a large portion of its shares for retail investors. Sources say only around a quarter of them went to that group. And Apple has sold $6.5 billion of bonds as it increasingly looks to return cash to shareholders. Sources tell us the largest portion, or rather the longest portion, a 40-year security, will yield 0.92 percentage points above Treasuries. The proceeds could be put forward towards stock buybacks, dividends or acquisitions. And that's your Bloomberg Business Flash. Anna?
Thanks very much. Annabelle Jewellers joining us there with our Business Flash. Now, the world's biggest vaccination campaign in history has reached the milestone of 4 billion doses administered. That's after more than 4 million people have died from COVID-19. The US and Asia are among the regions still grappling with the spread of the Delta variant. Bob Parker, Quilvest Wealth Management Investment Committee member, is still with us. Bob, in terms of the spread of the Delta variant, how vulnerable are your assumptions about the US economy to the spread of this variant? Or do you just make the assumption that however bad it gets in those more lowly vaccinated communities, however bad it gets, we won't see really draconian lockdown measures, and so estimates of growth won't be under threat? What assumptions are you making around that spread?
Well, I think, first of all, on the states, clearly there are sort of regional problems, and that's particularly when one sees low vaccination rates in the southern states in the US. Will that sort of derail the US economic recovery? I think not. And, after the second quarter GDP number, which was slightly less than expectations, but even so, it was still a very robust number. And, the IMF and the US Treasury and the Fed are all forecasting growth this year close to 7%. And I think, if anything, growth next year is actually going to, be well above 4%. And, IMF projections of, close to 5% growth next year. I think that's highly likely that the growth outlook we're not going to see because of base effects, the very strong numbers in the first half of this year, but it's going to be a moderation rather than a slowdown in US growth. In Asia, vaccination programs, which have been very slow and have really been challenging in a number of countries. I'm working on the assumption that the vaccination programs are going to accelerate quite dramatically over the next 6 months or so. So I'm assuming that, yes, there are going to be pockets of problems with Delta variants, possibly other variants. And I think it's naive to assume that the COVID problem is just going to automatically go away. So it's going to be volatile, but I think the trend is one of economic recovery, literally globally over the next 6 months to 18 months. And I just refer you to the IMF global forecasts for next year of 4.9% growth. After this very strong recovery this year.
So we're on a path to recovery. For how long do we assume that central banks will have our back then, Bob? How long do you expect the Fed to remain as generous as it is? The taper conversation very active this week, of course, as we saw more baby steps towards tapering with some tweaking of the language and other measures from the Fed. What assumptions are you making then around the timing there?
Well, the Fed, I think, are actually very clear. They are very worried about the possibility of a taper tantrum. They are deliberately going to move very slowly. I think, starting in the fourth quarter, and this is not the market consensus is that tapering will start in the first quarter of next year. I actually think in the fourth quarter of this year, given the overheating that we have in the real estate market, they're probably going to start to wind down their purchases of mortgage-backed securities. So, that 40 billion a month could come down to 20 billion a month in the fourth quarter, but they will keep up with their 80 billion a month in US Treasuries probably until the first quarter of next year. But the whole process is going to be very slow. And I think sort of two themes. All central banks are, as we say, behind the curve. That means that real yields stay negative, and that purchases by the central banks continues to depress government bond yields worldwide. So any rise in government bond yields is going to be moderated by those purchases. I think the other point is one of sort of nuance, which is that one is definitely getting a more dovish tone from the ECB than we are from the Fed. And therefore, I question, those commentators who think that, the US dollar is going to weaken on trend, because if we have tapering initiated by the Fed rather than the ECB, that should support the dollar.
Thanks so much, Bob. Thanks for joining us. Bob Parker, Quilvest Wealth Management Investment Committee member. Bob will be continuing his conversation with us on Bloomberg Radio at 9 a.m. UK time. That conversation coming up then in around 40 minutes' time. I'll be heading to Bloomberg Radio. Before that, right here on Bloomberg TV, though, coming up, Amazon's pandemic boost fades as vaccinated shoppers venture out. The world's biggest e-commerce retailer predicts slower sales growth. We discuss. That's next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the European market open. 21 minutes into our European trading day, and European equity markets under pressure this morning. We have the Stock 600 down by 0.7%. Let's talk about what's going on in the technology space, because this is something that is weighing on sentiment. Has Nasdaq futures down by 1.3%. So it appears that Amazon's pandemic bump is fading, and vaccinated shoppers have started to venture out. The world's biggest online retailer reported sales and gave a forecast that fell short of expectations. It's the first time Amazon has missed quarterly sales estimates since 2018. Joining us now to break down the latest set of Amazon results is Bloomberg Intelligence analyst Matthew Bloxham. Matt, good to speak to you once again then. So take us through the highlights here. I suppose we shouldn't really be surprised that Amazon got a boost from the pandemic, and then as people venture out, they'll suffer from that. But no doubt some people will have been more convinced by buying online than pre-pandemic, and some of that habit will stay.
Yeah, I think that's right. I mean, it was definitely a fairly sobering update. And if anybody was unsure if the tech pandemic party was over, I think Amazon definitely put those doubts to rest yesterday. So, still very healthy growth in the quarter, 27%. A big slowdown from last quarter when they grew revenues 44%. And they said that the guidance for next quarter is only 10 to 16%. Analysts were looking for 20. And the CFO yesterday on the call was very cautious, saying expect some muted growth for the next few quarters as they lap those really strong periods from last year where everybody was stocking up for work from home. But yeah, I guess it's a bit inevitable that there's going to be a bit of a bounce bounce back. People have spent 18 months or so locked indoors, and they're going to go out and shop in the real world. But as you said, definitely the underlying shift is towards doing more stuff online. So they're still going to be growing 10 to 20%, still make a lot of money. So it's not complete doom and gloom, just a relative positioning against expectations.
Yeah, and it's interesting to think about the competitive environment that businesses like this operate in at the moment. They're not just up against other shops that sell stuff. They're up against all the other things we can do with our money now, which we couldn't do for a year and a half, going out for food and the like. But there were some positives, though, Matt, in these numbers. But investors are not focused on that. The after-hours move, the NASDAQ futures all suggest the market's not focused here. But what are the positives that you pulled out?
Yeah, that's right. I mean, I guess the big one is still the really strong growth at Amazon Web Services, which grew in line with expectations, 37% revenue growth. It's still by far and away their most profitable business, overshadows the e-commerce business in terms of profits. That's still the market leader. I guess on balance, people are a little bit concerned, but they have been for some time, that Google and Microsoft in particular will catch them up. Their equivalent cloud businesses grew about 50%. So, that business is still humming along nicely, still generating huge amounts of profit. But there's definitely a bit of a threat in the background from those other tech providers.
Matt, thanks very much. Thanks, as always, for bringing us the tech story. Matt Bloxham, Bloomberg Intelligence analyst, with a focus on technology then. Let's get to some of the other movers. We've got so many stocks on the move this morning, so many stories to tell, that we thought we'd bring a few more to you. So let's start with Iliad. This is the telecoms business that you might remember just a couple of hours ago. We got the billionaire owner who owned a lot of this already decided to buy the rest of it. And as a result, we see that stock up by 61%. So that stock moving substantially higher, reflecting the offer price. We also have some M&A taking place, perhaps, probably, in the Italian banking sector. At least they're in talks to. UniCredit and Monte Paschi in talks about doing a deal. This under the relatively new leadership of Andrea Orcel over at UniCredit. He has a background, of course, as we know, in plenty of M&A. And so he's bringing that M&A experience to this job and trying to put together this Italian deal, which we know will have the backing of the Italian government, broadly speaking, because it is something that the government has been trying to do for a long time, working out what to do with Monte Paschi. This was a troubled business, beset with issues, and fell into the government's hands at the height of the global financial crisis, and has been an issue ever since. So it seems as if we might make some progress towards that story. Even if we're not saying the cross-border M&A in the banking sector, we are perhaps seeing a little bit of the intra-national M&A taking place. Coming up then on this programme here on the European Market Open, it is one of the world's top installers of green power. We're going to be speaking to the CEO of EDP over in Portugal, important Chinese ownership of that business as well. That conversation coming up next. Where do they see their growth? How competitive is the market? Where do they see the new competitors coming from? All this money that's trying to flow into green energy, how is it changing the assessments they make over at EDP? And what kind of input costs are they up against when it comes to making or securing some of these wind turbines? This is Bloomberg.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. Half an hour into Friday's session. We're under pressure here in Europe, down by 0.8% on the Stocks Europe 600. The Xetra DAX in particular, down by 1.25%. We're being pushed lower by a couple of factors, one from Asia, one from the United States. The Asia story is, of course, around China once again. We seem to be preoccupied in the Asia session with the regulatory clampdown that we're seeing on certain sectors in China. And then in the United States, we had the numbers from Amazon. They're certainly weighing on NASDAQ futures, and Europe seemingly caught in the middle. We've also had a lot of corporate earnings out from Europe, though, causing certain stocks to go their own way. Let's have a look at the sector breakdown. It might give us a sense of where the trends are coming from, if you like. All sectors in negative territory, which is the first obvious thing to say about the sector breakdown today. Basic resources is the worst performing sector, down by 2.3%. Travel and leisure down 1.9%. We've had corporate reporting from the travel and leisure space, Air France, IAG, and the like. Looking for the banking sector, it's not doing too badly compared to the rest, but it is still down by 0.5%. All in all, as is healthcare. We've had corporate reports from both of those sectors this morning. Let's get a Bloomberg First Word News update. Here is Annabelle Drewlers.
Thanks, Anna. Well, Japan plans to expand a state of emergency to areas around Tokyo and extend it to the end of August. That in the face of a record surge in virus cases. The country, though, has so far suffered fewer COVID deaths than any other G7 nation, but only about a quarter of its population is fully vaccinated. Cases directly linked to the Olympics, though, remain relatively low. Officials overseeing the transition away from LIBOR in the US have formally endorsed a series of forward-looking benchmarks. The announcement should pave the way for the widespread use of the interest rates from CME Group, which are tied to the secured overnight financing rate. It comes just 5 months ahead of the deadline to ditch LIBOR for new deals. Israel will offer a COVID booster shot to people aged over 60 who've already been fully vaccinated. Now, this makes it the first country to offer a third dose of the Pfizer-BioNTech vaccine to its citizens on a wide scale. The decision comes at a time when infections are rising, though neither the US nor the EU have approved booster shots. Black Widow star Scarlett Johansson is suing Disney for streaming the film online at the same time that it opened in theaters. In court filings, Johansson claims Disney tried to draw audiences away from theaters to its own streaming platform. She says Disney promised the film would have an exclusive theater release for at least 90 days. Disney maintains it fully complied with Johansson's contract. Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna?
Annabelle, thanks very much. Annabelle Drewlers there with your First Word News update. Now, Lisbon-based EDP has reported first-half profit that beat estimates, rising almost 9% on the year to €343 million. However, EBITDA fell almost 10% at EDP, one of the world's top installers of green power, dropping to €1.69 billion. Joining us now is Miguel Stilwell-Andrade, who is the CEO of EDP. A pleasure to speak to you, Miguel. Thanks for joining us. I'll ask you about the numbers you just reported, and perhaps a specific focus on costs, because we're thinking about that with a lot of our guests at the moment. What are the inflationary pressures that you're seeing? There are a lot of people going after the wind turbines that you're also going after. What can you do about that on the cost side?
First of all, good morning. It's great to be back on the show. I'd say on the cost side, one of the things that we do is whenever we take an investment decision, we immediately lock in the costs. And so we currently have multiple gigawatts that are already locked in, that we have secured, that we're going to be building out over the next couple of years. And 90% of those costs have already been locked in with the suppliers. So we only have a partial exposure on around 10% of those. And so we expect that the impact on the overall costs will be relatively small in the overall context. We have a spread, let's say a return on these investments of around 3%, 3.2%. spreads, and we think it will continue to be around 3% even after taking into account any inflationary pressure.
So you paint a picture where you've managed to lock in some costs, and so maybe it takes a while for the cost pressures we're seeing in markets right now, Miguel, to catch up with you, but perhaps they will in years to come then. What will you be able to do with that? Absorb it? Will you have to absorb it in margins, or will you be able to pass that on?
That's a great question. Obviously, whenever we bid in an auction or whenever we participate in some sort of RFP for PPAs with customers, we are building into our projections the best estimates we have for the costs. And so at any particular time when we are bidding, we are taking that into account. And so that will be naturally reflected into the energy prices that are being contracted at any particular time. I just say though that, given the inflationary pressure we've seen over the last couple of months, in any case that translates to approximately $1 to $2 per megawatt hour, which is relatively small in the overall context. So I think it's still something that's perfectly manageable. And I think we continue to see renewables as being extremely competitive, particularly also given what's happening sort of in some of the commodity markets. We see it being even more competitive now, given where the market is.
Yes, and sticking with the cost theme, can you give us some thoughts on the different levels of cost that you see between developing onshore and offshore wind projects in Europe specifically? How is that evolving? Are you seeing a narrowing of the gap, or are they still remaining far apart in terms of the costs incurred?
So onshore technology is a much more mature technology. It's been around for many decades, and it's obviously had a lot of time to continue to be more efficient. So we're currently seeing onshore projects, let's say sometimes in the 30-40 euros per megawatt hour levelized costs of energy. In terms of offshore, still slightly higher, but it's a newer technology, but it is evolving very fast. So there are a lot of projects that are being built or that have been developed at the moment, both in Europe and also in the US, and we are seeing sort of that translate into lower costs as that technology also matures.
Okay, so it's about the maturity then of the technology. You mentioned how things are competitive when you're looking at assets. Things are competitive. Where in the life cycle of a renewable energy project, Miguel, are you seeing that competition? Are you seeing new bidders appearing at the tender stage, at the auction stage, or are you seeing new bidder interest really coming as you try to sell on completed projects? Where is the new competition? Because so many people want to get involved in green energy and cleaner energy. Where do they find their entry point?
Well, as you say, it's a very exciting time to be in the sector, to be in this particular space, because there is a lot of demand, but it's a very fast-growing market. It's a big market and very fast-growing. And we see people coming in at all stages, and that we think is very positive. Certainly in the development phase, we see a lot of smaller players that are doing the permitting, taking the smaller projects and sort of developing them in the early stage. We see some of the bigger strategics also sort of in that development phase and actually taking those projects then to commercial operations. Once they're actually built, we then see a lot of infrastructure players actually coming in and wanting to buy those assets because they typically have predictable long-term yields, long-term contracts. And so we see a lot of players wanting to buy those operational assets. And so we are typically more focused on that initial phase of the development and taking it construction and then taking it to commercial operation. Once they're built, we will keep some of those assets, and others we will sell on to infrastructure funds, pension funds that want these predictable, stable assets.
Can you tell me, Miguel, a little more about your Brazilian business and what you plan to do with it there? Can you share details on what you plan to do with hydro assets and other assets in the country?
Sure. So our Brazilian business it's a listed business in Brazil. We've got around 55% of it. It's got a fantastic networks business, distribution. It's also got a very fast-growing transmission business, transmission lines. So we just recently won one of the auctions in Brazil to build additional lines there. And then we also have a hydro business, which is also in that company. We are currently also doing an asset rotation. So we are selling some of the transmission lines and reinvesting that capital back into the business, into these new auctions, into new projects. So that's part of what the restructuring we're doing in Brazil. And we're also looking to potentially reduce part of that exposure to hydro in Brazil. And so We also have talked about that in the market for a while, that we would look at reducing the exposure to hydro. So Brazil will tend to become more of a networks play, more focused on distribution and transmission in the future.
Okay, do you have any more on the timescale of any of that, Miguel, and also on the natural gas generation assets? So the timescale on Brazil and natural gas, you've sold, I think, some of your assets there. Do you have any plans to sell more?
Yes, so in terms of timescale for Brazil specifically, so we're looking at over the course of the second half of the year that we would be able to publicize or speak out in terms of exactly concrete transactions that we've executed. So over the next couple of months, I'm sure we'll be back out with very specific details on that. In relation to the gas assets, as you mentioned, we sold some gas assets last year in Spain. We still have around 2.9 gigawatts in Iberia, between Portugal and Spain. What we've committed is to going all green by 2030. So we're already phasing out all of our coal. We will be phasing out the gas assets over the next couple of years. So we'll be coal-free by 2025, all green by 2030, and we'll be, let's say, running processes on that over the next couple of years. So that's more a medium, long-term play.
Miguel, thank you very much. Thanks for joining us. Good to speak to you once again, Miguel Stillwell-D'Andrade, the CEO of EDP. Coming up on this program, we'll stick with the earnings story. We'll speak to the CFO of Swiss Re after the reinsurer reports first half earnings and as it assesses losses from Germany's recent catastrophic floods. That conversation next. This is Bloomberg.
Said was we need to make them in America. Does that include overseas companies making them if they have the plant in America?
I would certainly be in favor of them having operations in America. Absolutely. You know, Samsung, TSMC, there are companies that are in allied countries, and you know, we certainly want them operating in America and producing chips in this country, yes.
So we have a significant chip issue, but there are other supply chain issues as well. As I know you're monitoring what's going on. Where have you seen other problems in the supply chains right now in the United States that need to be addressed?
Particularly in home building supplies, you know, lumber and all the related supplies, glue, adhesives. And you see it playing out. You know, home prices are high. If you go to Home Depot or Lowe's, you'll see prices are a little bit high. So, and that's all because of the lack of supply, just disruption.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Valuations, particularly, you know, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Welcome back to the European market open, 8:44 here in London. So 44 minutes into a negative session, the Xetra DAX in particular down by just over 1%. The FTSE also on the back foot. The CAC 40 performing a little better. Let's talk about the reinsurance business. And Swiss Re says it's bracing for losses this year linked to flooding in Europe and protests in South Africa. The reinsurer reported net income of 1.05 billion for the first half versus a 1.14 billion loss last time. Joining us now is John Dacey, the Swiss Re CFO. John, very nice to speak to you. So back to profit then after the losses of last time. Tell me a little about, clearly that was a story of COVID-19 impact. Tell me a little about how that has evolved and hit the business and worked through.
Sure. So the COVID losses in 2020 were actually quite large for us, but especially on the property casualty side. What we see develop here in the first half of 2021 is we continue, unfortunately, to have major mortality losses, especially in the United States in the first quarter of this year, but they've continued to a lesser degree in the second quarter. We booked a loss of $870 million related to COVID. 810 of that is in our life and health re business. The property losses have in fact reduced to a very small number, and we don't expect them to grow anytime in the next 2 quarters either. We think the losses for mortality will continue, unfortunately, but as major markets continue the vaccination programs and we see people actually responding very well to these, hospitalizations down, deaths down, that number will also be a fraction of what it currently is.
Yeah, sadly, the mortality does continue. And some of your competitors, I'm thinking of Munich Re here, talking about other geographies as a focus, India and South Africa. Depending on your geographic exposure, you've already referenced the United States. Where else do you see the impact?
So there are some other markets. Earlier in the pandemic, the UK was a source of some losses for us. With respect to the increase in mortality, obviously the spike that you saw or have seen in India, in South Africa and Latin America are all tragedies from a human point of view. With respect to insured losses, at least for Swiss Re, that they're not trivial, but they're not anywhere near as important as the major market of the United States for the mortality insurance that we have.
Okay, going on to another set of events, I suppose, that we keep very firmly in our minds when we think of the reinsurance sector, and that is climate events. And I'm thinking of the flooding in particular that took place in Europe earlier on this year. I see from your statement this morning, you put that in with the social unrest in South Africa, and you talk about a mid-triple-digit million US dollar loss for Swiss Re. Sticking with the flooding, how do you go about assessing then what kind of impact this is going to have on a business like Swiss Re?
Sure. So this is, in fact, our core business, the reinsurance and direct insurance through corporate solutions business of natural catastrophes. In the first half of the year, in spite of what were approximately 700 million of nat cat losses, we were showing that this profit of 1 billion, including the COVID, 1.7 billion ex-COVID for the half year. Here in the third quarter, we do expect that the floods in Germany and surrounding countries of the Netherlands, Benelux, will have a significant impact. It will be a major loss for the industry. It's just too early to put any precise numbers here. We're working closely with our primary companies to try to understand their losses and what part of their losses actually then get passed on to us as an ultimate risk absorber in the system.
Yes, and you must have to make your own assumptions about how frequently these extreme weather events will occur then, John. What kind of assumptions do you make when it comes to flooding and to wildfires over the decades to come? What kind of assumptions are you making about the frequency with which we will see these events?
So we've made some major adjustments in our models over recent years precisely for this. What we refer to is the secondary perils, oftentimes related to what the scientists refer to as convection storms that result in either the flash flooding that you saw in Northern Europe, hailstorms, other major events related to regional weather systems, as well as the major drought that we see in many parts of the world, especially in the Western United States and Canada this year and actually in the last couple of years. And so as we've modeled this, we assume that the frequency and the severity of these losses will increase. We put that into our own pricing model. It's had us walk away from some risks that we don't think are correctly priced, but also encouraging the industry to be more realistic about what the ultimate cost will be of these new frequency and, as you say, severity of extreme weather.
What do you think, thinking about the European floods, John, what do you think will be the impact on the ability to access insurance in those areas, or the pricing of that insurance? Do you think it's more likely that we see insurers pulling away from offering insurance at all, or just that the premiums will increase?
I hope that we'll find a better solution, which is to offer insurance, but also to encourage people to find ways to improve the resiliency. I can give you the example here in Switzerland. After a series of similarly catastrophic floods in 2005, the insurance industry worked together with the Swiss government to try to improve the flood controls and the building codes to make the affected areas safer going forward, and that allowed those communities to maintain access to insurance. I think governments in general are going to have to think more holistically about how we can improve the infrastructure, understand that what had been a 1 in a 200-year risk is now a 1 in a 50-year risk, or maybe even a 1 in a 20-year risk, and adjust accordingly. But there should be ways that we can solve this. It may be more expensive because the losses may be bigger, but we can also at the same time find ways to make the world more resilient.
Really interesting to speak to you. Thanks very much, John. Moving from a 1 in 200-year risk to a 1 in 50 or 1 in 20. Interesting analysis for us. John Dacey, the Swiss Re CFO. Thanks very much for joining us. Coming up on this programme, we'll get back to the earnings season and what we've learned from it. It's in full swing. Key European growth data has also been released today. So we'll look at what is driving the markets this morning. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. 54 minutes into a negative session for this Friday, down by more than 1% on the Xetra DAX, not far off that. on the London market. Let's talk to Laura Cooper, Bloomberg Markets Live macro strategist. Laura, what is it that's really weighing on Europe? Because we've got the sort of negative flow from Asia. That's very much a China story. And then we've got the tech story from the United States, which does sometimes find it difficult to read across into Europe. So why quite so weak on this last trading day of the week?
Well, I think overall it's just European equities are taking their cues from the broader downbeat global risk sentiment. But if anything, I do think this sets up for what's to come over the next couple of months, because we do tend to see quite volatile European equities in July and August just on a seasonal basis. So for now, European equities have had stellar earnings and just monetary accommodation to help them keep at these record levels. But at the same time, we do have these delta risks, we have inflation pressures, and so on average monthly returns for the stock 600 tends to be down around 1% through August and September. So I do think this is setting up for more volatility ahead.
Do we find that the earnings story cutting through on days like this then, Laura, with the backstory that you paint there?
Well, it's interesting because if we look at kind of the average stock in the stock 600, it's actually the price action is down the following day within the next 24 hours, about 0.1%. So, but I think it's a case of really divergence. So, for example, we have cost pressures is a common theme coming through that is helping some stocks react quite sharply, for example, in the commodity sector, whereas we know that in the consumer staples are coming under pressure. So I really think it's a case of what the guidance is telling us that is driving a lot of that price action following the report.
Laura, thanks very much. Thanks for joining us on the European Market Open today and many days this week. Thanks very much for spending time with us. Laura Cooper from the Markets Live team. That is it for the European Market Open. Surveillance Early Edition is up next. European equity markets, as we were just discussing with Laura then, on the back foot. A number of earnings stories do seem to make it through, have something of an impact. Just looking at where we are trading on some of those this morning. NatWest Group down by 1%, IAG down by 3.4%. It's in Air France also weaker, but not quite as much. 0.8% to the upside. Iliad moving much higher on French M&A in the telecom space. Lots still to discuss this week then. This is Bloomberg.
Week on Bloomberg Green, the rise of green finance.
What we're trying to do is to have a positive impact in every investment and to future-proof those investments.
2021 is the year of sustainable finance, but how do we make sure that all of this money is as green as it's supposed to be?
We know the direction is clear, but the road will be bumpy.
The European Union lays out the green standard for bonds, tightening up rules for banks on climate change.
We see a real link between the impacts a company makes on workers and society and the community, but also on climate and the environment, on the long-term financial value of these companies.
And turning money into motion, the story of how one small activist investor took on an oil giant. I'm Danny Berger in London, and that's what's coming up on this week's edition of Bloomberg Green. Catch it on TV, Quick Take, and online.
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
For the people here on Earth who are wondering why are we investing all this money in space, this time in space, talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far.
We're just finding out that quantitative easing is very, very powerful in pushing around bond yields and bond prices.
We certainly are proud to have one of the largest retail allocations ever.
Our offices are evolving into more hybrid spaces, more flexible working.
This is Bloomberg Surveillance, Early Edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. Beats and buybacks. BNP Paribas sees a rebound in equities as NatWest announced a plan to return capital after reversing loan loss provisions. We'll hear from both banks. Renault's restructuring starts to pay off. The French car maker beats in the first half even as the chip crunch crimps its outlook. We'll speak with the CEO shortly. And Amazon fails to deliver. The e-commerce giant set to slump after missing estimates for the first time since 2018. So let's bring you some economic data just crossing the terminal. German second quarter GDP 1.5%. The estimate was 2%, so that is indeed a miss. Look, we saw a similar picture with U.S. GDP yesterday as well, but within that, there were some strong places as well. So we'll dive through this data, see exactly what missed and where the strong parts might be. Of course, German inflation also a concern for these markets at the moment as well. And let's get straight to the markets. It's a busy week of earnings in Europe, and it's coming to a close with numbers from big banks, energy companies, and manufacturers coming in thick and fast. Now, just this morning, we spoke to the CFO of BNP Paribas after the French bank saw an uptick in its equity trading business, but a decline in FICC income.
The levels of 2020 were extraordinarily high, and so there is a reduction. And this reduction, what we are seeing is in line with what you see if you take the European and the US banks.
Now, at the same time, NatWest says it aims to distribute a minimum of £1 billion a year from 2021 to 2023. It'll do that by a combination of ordinary and special dividends.
Strong performance across all of our businesses, driven by an increase in lending with mortgage growth. The mortgage market here remains very strong. And as we come out of lockdown, consumer spending is starting to recover back to pre-COVID levels. What we're seeing is, very low level of defaults. Businesses have been remarkably resilient. There's a lot of support still in the economy, but as we come out of lockdown, confidence is coming back.
Let's get further into this earnings discussion. Joining us now is Maria Weitmana, Senior Multi-Asset Strategist at State Street. Maria, thanks so much for joining us. A very volatile and busy week you're joining us here on the tail end of. I do want to pick up, though, just on those comments from the NatWest CEO who said, look, we've seen a very low level of defaults. And this is something we've heard from a lot of European banking CEOs. So, Maria, did we just kind of skip the default cycle here, or are they just to come?
No, I probably, I have a lot of sympathy with what NatWest was talking about. I mean, we are living in a world where money are virtually free, so it's almost kind of difficult for anyone to default. I mean, you have very, very easy access to capital, so we know financial conditions are unprecedentedly super accommodative. And what actually we've seen in the numbers is that lots and lots of corporates have able to borrow at a lower rate. Lots of consumers have been able to borrow rate. We lengthened the duration of those loans, of credit. So it does set companies in a very, very good stead to continue kind of their investment plans, their growth plans. So that's great for the companies. I'm not entirely sure how great it is for banks. I mean, yes, quality of the loan books has improved, great, but they're actually locking in into fairly low interest margins for quite some time. So we do have some worries on that front. So, okay, it's good not to default, but giving out like very, very cheap money for long term, that might be an issue longer term. but not yet.
Yeah, fair enough. Yeah, fair enough. And look, these companies certainly do have strong balance sheets. They have lots of cash. How do you see that cash being put to work this quarter? We certainly see a lot of dividends, a lot of buybacks. Is that where that extra cash sitting on balance sheets is going to be going?
Yeah, I suspect a lot of it will be returned to shareholders. But what we are actually really, really excited in this earnings season, and what we heard from a lot of companies, is increasing talk about CapEx. That's really, really exciting. I mean, we know that companies, particularly like industrial companies, have been underinvesting for quite a long time, for almost a decade, if you kind of did track the series. So potential for investment is really, really exciting, and that can create a long-term kind of stable and more profitable growth. And it's not that only that they can invest, they actually have to invest. I mean, we heard a lot about reshoring, rebuilding supply chains, kind of investing into kind of more stable production. So those things can happen and need to happen, and companies in very, very unique opportunity to be able to do it. So that's really exciting.
Okay, so what sector then are you seeing that and are you excited about?
I mean, industrial look really good. So they're probably kind of the biggest recipient of it. A lot of consumer stuff, like places like autos, maybe like durables. So that's potentially very, very interesting. Majority of them, I would probably say, in cyclical sectors, kind of old economy cyclical sectors. We know tech has been investing for years and will probably continue. So they're probably on the margins at a bit less, kind of a bigger story, but kind of old economy cyclicals that we kind of haven't looked at very, very favorably for quite some time. That interest is coming back there.
Yeah, it's interesting you say that, because we also heard from Bernstein yesterday putting out a note saying, look, European value, not only is it cheap, but it has bigger growth potential, earnings growth potential than its U.S. counterparts. Maria, are you a buyer of European value as well?
With reservations. So there are some parts of European value we really like. So kind of those kind of industrial consumer cyclicals we really, really like. Banks were a little bit more concerned, and exactly for the reason we kind of talked about the kind of locking in into lower interest margins, how far, I mean, we do expect obviously recovery, and interest rates probably will recover from kind of current slump and will maybe go a bit higher, but probably not too high. And then banks really, really need it. So I think part of value is really interesting, and I really hear what Bernstein is talking about. So European stocks in general, European cyclicals, what they want, they have lots of operating leverage. They're exporters. They need global economic recovery, and that's kind of exactly what we're having. Better economic growth around the world, and Europe is really, really good place to kind of play this story.
Right. Maria, thanks so much. You're going to stick around with us. We have much more to discuss. That's Maria Weitmana from State Street. Now, coming up, Amazon's pandemic boost starts to fade as vaccinated shoppers venture out. The world's biggest e-commerce retailer predicts slower sales growth. We're going to discuss that up next. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it, because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so. which is the track that we are currently on.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now let's get to the first word news. Here's Leanne Gerrans. Good morning, Leanne.
Good morning, Danny, and thank you. Japan plans to expand a state of emergency to areas around Tokyo and extend it to the end of August in the face of a record surge in virus cases. The country has so far suffered fewer COVID deaths than any other G7 nation, but only about a quarter of the population is now fully vaccinated. Cases directly linked to the Olympic Games do, however, remain relatively low. Now, officials overseeing the transition away from LIBOR in the US have formally endorsed a series of forward-looking benchmarks. The announcement should pave the way for the widespread use of the interest rates from CME Group, which are tied to the secured overnight financing rate. It comes just 5 months ahead of the deadline to ditch LIBOR for new deals. Now, Israel will offer a COVID booster shot to people over 60 who've already been fully vaccinated. That makes it the first country to offer a third dose of the Pfizer-BioNTech vaccine to its citizens on a wide scale. The decision comes at a time when infections are indeed rising. Neither the US or the EU have approved booster shots. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. Now, on to Amazon, which says it expects slower sales growth in the third quarter as the boost from the pandemic subsides. Customers turned to Amazon and other online platforms during the COVID crisis, and that led to a record profit for the e-commerce giant. But Amazon's breakneck growth is beginning to level as customers start to return to the high street. Amazon shares dropping in pre-market so far. Maria Vetmana from State Street is still with us. So, Maria, during the pandemic, when a lot of shares were selling off last March, it was really tech that kind of led us through the market, kept things afloat. Does the leadership start to shift now that the economy is going to normalize?
Yeah, I think that's been quite a big story. Probably like more in the Q1 this year when we said, okay, what else other than tech? And we had quite a lot of like cyclical industrials commodities doing better. What was interesting in Q2 is that actually market came back to tech. So every time we have any kind of pandemic scare, we have growth scare or like new variants coming back. So that almost naturally kind of leads investor back to tech. They benefit from lower interest rates. They benefit from any kind of indications that we might have more lockdowns, which we're seeing that quite a lot of like in Asian markets. So So technology, I mean, what I'm trying to say basically is that I probably wouldn't write tech sector off. And I mean, thinking about Amazon, companies that makes 50% earnings growth and market is disappointed. I mean, I feels a little bit like we're getting a bit too greedy with it. But I mean, all technology sectors had a fantastic earnings. Yes, they're talking about potential risk and returning to some sort of normal rate of growth, not 50-40%. That's obviously excessive, but it is a sector that can make money in downturn and an upturn. So I think we probably, it's too early to write it off.
So you wouldn't write off tech, but would you write off China tech at this point, Maria?
Yeah, China tech is actually very, and thanks for bringing it up. It's very, very specific story, right? So it probably has a lot less kind of read across to global tech. So it's about Chinese government wanting to have control over what big tech giants are allowed to do, whether they're allowed to cross between tech and finance, and which parts of the economy they can go, and how much control the government will continue to exert over them. So that's very, very specific. That's on China. What I would probably say, thinking about Asian tech, is that Korea and Taiwan, the kind of powerhouses of semiconductor industry, they still look very, very interesting. And so as with always, we have to be a bit more selective, but the China tech is very, very specific issue. I would probably venture to say that it's probably not very systemic issue, given it's kind of investors begin to get a grip and understanding is, okay, that's part of the economies, and Chinese government wants to have a control, but they still want to have economy growing strongly and be investor friendly.
Right. So, I mean, speaking of trying to keep the economy growing, I wonder kind of what you do with some of the divergence in terms of GDP growth. You have China maybe expressing some concerns, or there had been some concerns around growth in GDP. I mean, do you see a big divergence between regions? In other words, do we not get that altogether sort of economic growth throughout the world?
Yeah, no, that's really interesting. And I think maybe the question is, for years, we had China and kind of commodity-led boom. That being the main engine of growth globally, and that was really, really important. What we're beginning to see is a kind of the center, the kind of engine is shifting maybe towards Western economies right now. So US and maybe Europe, they're talking a lot about kind of stimulating the economy. We know interest rates are super, super low, but the government talking about extra investment, infrastructure spending, that's keep gathering momentum. I mean, if you think back to GFC, the way to get out of crisis was austerity. Now the kind of the accepted kind of mantra is that we have to spend out of crisis, and governments are increasingly looking into it. So I suspect it's the center of gravity is changing. It's a lot more. I mean, it affects sectors you buy, it affects your investment opportunities. I think it's really interesting to look at European equities right now in that sense. They I mean, very kind of industrial heavy, so they're manufacturer heavy, as we produce things in Europe. They should benefit from that environment.
Right. Maria, so great to have you on today. A happy Friday. Enjoy the rest of your weekend. That's Maria Weitmana, Senior Multi-Asset Strategist at State Street. Thanks again for joining us. Now, coming up, we discuss Robinhood, which flopped on the first day of trading. We're going to hear from the firm's CEO and dig into why exactly they had that flop. That's next. This is Bloomberg.
navigating what seems to be a really tough situation better than almost anyone else.
We've worked hard on the supply chain. There's no question there's a lot of work to do in the supply chain for semiconductors. And we're happy that we were able to exceed our second quarter guidance as well as, guide up for the rest of the year.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's really humbling that 6 short years after we launched our product to the public, we have over 22 million customers, and we're on this journey with our customers and allowing them to participate in the offering.
And speaking of your customers, you said you'd allocate 20 to 35% for Robinhood's own users. We're hearing that somewhere in the range of 20 to 25%, still one of the biggest allocations ever. How did you get to that number? And are you concerned at all about volatility?
Well, we certainly are proud to have one of the largest retail allocations ever. And the way that we think about it is it's a long-term focused company, and we're making decisions and making big bets with the long-term interest of the business in mind. So volatility, comes and goes, and we're not going to be commenting too much on daily fluctuations of the stock price.
The retail movement, though, is a phenomenon, the meme stock movement, a phenomenon. And looking at social media, just this morning, there are strong feelings out there about what Robinhood represents. When you think about GameStop, when you think about AMC, do you get at all worried about Robinhood becoming a target of its own users?
Yeah, we're not really thinking again about anything that happens in the market, especially in the short term. The goal is to keep making great products, to keep improving the service, and keep growing with our customers. And I think we've seen certainly finance become more important and the retail investor become much more important within investing. And that's something we think will continue.
You live streamed your roadshow to the public. You said that more products are coming, maybe even retirement accounts like IRAs. When should investors expect those kind of things?
Well, one of the things that we've been really excited about is turning first-time investors into long-term investors. You can see that with some of the recent products that we've launched. It started with fractional shares, but then we built on top of that foundation with things like recurring investments, where if you're a customer, you can put in an order to buy a particular stock or ETF on a regular basis. And we're going to continue investing in that. We're seeing really, really good adoption, and we'd like to see a large portion of our activity be kind of long-term investing in the future.
Robinhood CEO Vlad Tenev there speaking to Bloomberg's Emily Chang about the firm's market debut. And it was not a very well-received debut, at one point dropping as much as 12%. So let's get into this more now. Joining us is Bloomberg Intelligence analyst Matt Bloxham. So Matt, a drop of more than 12% at one point. It ends down as well. How would you characterize the tepid reception for the IPO?
Yeah, I mean, I think there's a mixture of things going on there. I mean, I think it was to some degree just a bit mispriced, and maybe there's some tension there between the underwriters and the founder investors about where it should be struck. And also, as we heard a bit from Emily, I think a few missteps before the IPO from Robinhood about some of the volatility we've seen in the market. So, perhaps not the most enthusiastic investor base that they might have expected, and markets are feeling a bit toppy. So I think just a combination of factors in the short term that have kind of made this a little bit of a kind of underwhelming debut. But I think the democratization of trading is definitely a kind of a long-term theme that could play out quite well for them ultimately.
All right, Mac, I'm going to make you maybe do kind of a hard pivot here from Robinhood to a very different kind of media, and that's, of course, Disney. I mean, this was one of our most read stories of ScarJo suing Disney because they streamed Black Widow the same day it was available in theaters, crimping some of her profit. Disney had a very punchy response as well, calling it sad and distressing and the callous disregard for the prolonged effects of the pandemic. I mean, it seems like maybe not a great strategy to pick a fight with a very beloved celebrity for Disney.
Yeah, I mean, it's really interesting that this is kind of spilled out into the public domain. I know a number of similar issues have been settled out of court, but it just goes to show that the digital transformation that the pandemic has accelerated is affecting a lot of industries. And I think the way that the kind of economics of films, and we're seeing similar in music, has changed fundamentally. I think Scarlett Johansson's contract was struck in 2017 before any of this was going on, and theatres were, doing billion-dollar plus receipts. So I think it's going to, I mean, it's already going on, but I think it's going to really prompt a massive rethink about how movie stars' contracts are struck. There's going to have to be a shift towards streaming. And, we're seeing that in music too. We've got Universal Music planning to go public in September, and we've got similar issues going on there between artists and these platforms and how the value splits between them. So I think, this is the start of quite an interesting period for the content industry.
Yeah, fascinating stuff there. I have to say I did not watch Black Widow in theaters or streaming, but definitely need to see exactly what's being sued over. Matt, thank you so much. Thanks to Matt Bloxham from Bloomberg Intelligence. Now, coming up, mandating vaccines for the return to office. We'll discuss the future of the workplace. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find, managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
The curtain will rise again. Broadway's returning June.
Have you bought tickets?
Is busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance. Weekday mornings on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Beats and buybacks. BNP Paribas sees a rebound in equities as NatWest announces a plan to return capital after reversing loan loss provisions. We're going to hear from both banks. Renault's restructuring starts to pay off. The car maker beats in the first half even as the chip crunch crimps its outlook. We speak to the CEO shortly. And Amazon fails to deliver. The e-commerce giant is set to slump after missing estimates for the first time since 2018. Well, good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, a huge week for earnings, and NatWest among them, beating expectations for the second quarter and now planning to return cash to shareholders. Bloomberg caught up with the CEO, Alison Rose, earlier this morning.
What we're seeing is a good recovery in the economy as we open up, so we're cautiously optimistic about the recovery, but strong performance across all of our businesses driven by an increase in lending with mortgage growth. The mortgage market here remains very strong. And as we come out of lockdown, consumer spending is starting to recover back to pre-COVID levels. And our commercial business continues to provide strong support. So what we're seeing is, very low level of defaults. Businesses have been remarkably resilient. There's a lot of support still in the economy, but as we come out of lockdown, confidence is coming back and we see more optimistic outlook for the economy and very low levels of default. But, a strong and resilient performance. And obviously we have a very strong capital position, a capital accretive position, so that allows us to pay dividends and capital distributions to shareholders.
Good morning, Alison. As you said, it's some great results across the board there, and I can see that there's a plan of a £750 million buyback in the second half of this year. If the next quarter is just as strong and you continue to accumulate these excess capital, what will you do with that excess capital? Will you accelerate buyback programs further beyond what the government's directing, or will you turn to M&A or some other way of returning capital to shareholders?
Yeah, we've set a medium-term target to be at a 13 to 14% CET1 ratio, which is the right shape for a business like ours with very good risk diversification and a balanced book. So we have a clear path, and my clear preference is to distribute capital to shareholders, but also to continue to invest for growth within our business. And we're seeing good growth across that and potential for more organic growth. And then we will also consider any other options that add to shareholder value. But I think hopefully what we've given to the market is a clear indication of a steady capital return. We're investing $3 billion into the business for growth over the next 3 years in our digital transformation. And we will always consider options that add shareholder value as well.
What are NatWest's plans for office space if work from home or at least a hybrid structure is more the future? Will you keep your Bishopsgate campus and your Edinburgh campus?
Yes, we will keep those two campuses. I mean, we're evolving our working into a more hybrid way of working. I think certainly COVID has busted a few myths about how you can work. We were able to get 50,000 people working from home and continue to support, good operational performance and customer support during that period. So our offices are evolving into more hybrid spaces, more flexible working, but there will always be a need for offices. There will always be a need for collaboration and bringing people together. So our footprint will evolve, but our two big campuses are not going to change.
NatWest CEO Alison Rose there speaking with Bloomberg's Mark Cudmore and Anna Edwards earlier this morning. Now, Jefferies is mandating that employees who wish to return to its office must be fully vaccinated against COVID-19. Google and Facebook announced similar measures, and Citigroup has gone back to requiring staff to wear masks. Now, the highly contagious Delta variant is throwing doubt over a broad post-summer return to the workplace, but global real estate investment manager LaSalle sees office space remaining important to corporations. Let's speak now to LaSalle's head of European research, Brian Klinsiek. Brian, so great to have you on this morning. So you've just released your new outlook for the market. Office space still attractive, but what does the resurgence of the Delta variant and some of these more uneven plans of returning to the office mean for the outlook for the sector?
Look, what matters for real estate is not days and weeks, it's quarters and years. And I like to say that, even though we have the complication of the Delta variant and different countries are seeing bigger surges than others, to use a kind of Olympic metaphor, we've been watching a marathon, but it's going to be a photo finish. We see the conditions for a really strong rebound for real estate, including the office sector.
Yeah, that's really fair. I mean, it is easy to kind of get caught up in the day-to-day, who's letting their employees back in, how are they letting them back in. But as we do get this slow return, does the way that the office looks and the central business district, does that have to change compared to what it looked like before the COVID outbreak?
Yeah, the fundamental question, if you zoom out, isn't the future of the office narrowly. It's what is the future of in-person interaction? The pandemic has accelerated trends towards having more choice in where we live, where we work, where we shop. But there's something special about being in person with people. We've seen a resounding return, a resounding yes to that answer, the question of whether in-person interaction is special by people returning to socialize with one another as soon as restrictions are lifted. But that doesn't mean the office is going to be the same, and it has to be focused on sort of accentuating the strengths of being in person together. That's about collaboration. That's about creating a sense of FOMO, fear of missing out on something special that's happening by being together.
You know, I also think there's a smoothie shop right outside of Bloomberg, and I was there the other day, and the owner there was just saying, look, there's no one coming in here, even though people have started to return. I mean, it's still decimate. They said they were barely breaking even. What do you do right now with those retail spaces that kind of exist around the office place? Will those continue to be strong as they once were?
Well, the retail spaces in central business districts are an area that will struggle a bit if people are coming into the office 3 or 4 days a week instead of 5. And so I think we need landlords need a strategy and cities need a strategy to add more variety and life to those spaces. So more independent retailers, more independent F&B outlets, and really enhance that sense of FOMO and vibrancy, and not just another quick grab sandwich shop to have at your desk.
I do love a quick sandwich run, though, I must say. Brian, when it comes to housing, are we at peak housing demand in Europe and the UK?
I mean, the fundamentals of housing markets in Europe are really one of a structural undersupply. And so the run-up in prices and activity that we've seen has just been people accelerating choices that they were going to make anyways about the stage in their life, places to have extra space for their kids. That's been accelerated. But the fundamental, if you tot up the demand and the supply, there is still an underlying shortage. And so while activity may fall back a bit, we see, continued strength in residential markets, and it's one of our favorite sectors across Europe.
Brian, I'm afraid that's all we have time for, but it's great to speak to you today. That's Brian Klinseek, head of European research at LaSalle. Thanks so much for joining. And some breaking news to bring you. We do have a China Politburo meeting chaired by President Xi going on. Some headlines out of that: China Politburo to improve overseas listings supervision system. This, of course, comes in the wake of Didi and other IPO scrutiny that have listed in the U.S. They're also supporting faster development of the EV sector, so that's certainly relevant. We will be speaking with Renault just shortly. China Politburo also urging stabilization for housing prices and expectations. So again, this comes as we're expecting the China Politburo to hold a meeting on the second half economic work. So we'll continue to keep an eye on that and any headlines coming up. Now, as I mentioned, Renault feeling the chip shortage pain. The French car maker says rising costs could curb further recovery and profitability this year. Shares, though, moving higher after earnings that beat expectations. Up next, we speak to its CEO, Luca De Maio. If you have any questions for him, IB plus TV Go on your terminal. This is Bloomberg.
and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I think we have overcome chip shortages so far quite well, so we could manage, we could rearrange.
It's out of our control, essentially. It does seem like it's getting better, but it's hard to predict.
We've worked hard on the supply chain. There's no question there's a lot of work to do in the supply chain for semiconductors.
It is certainly better than it was, and I expect it will continue to get better with each month as we move further away from the disruptions caused by the pandemic.
Really annoying because we have a lot of customers wanting to buy our cars and we would like to build more and sell more. So as you said there, we don't see really that that's going to improve.
We're still seeing more demand than supply across our business, but things are continue to improve on the supply side.
But fundamentally, the only way to solve this problem is that we need to make more semiconductors in America.
Some of the key voices this week addressing the global chip crunch, and Renault is the latest automaker to address this, the chip shortage concerns. The French car manufacturer has doubled its estimate for car production lost to supply chain disruption. Renault now expects semiconductor constraints to see output drop 200,000 vehicles this year. Let's get more into that. We're joined now by CEO of Renault, Luca De Meo. Luca is a man with more than 2 decades experience in the auto industry, and I should say before joining Renault, he was the CEO of Seat for 5 years, and before then he worked for other automakers like VW, Fiat, and Toyota. His appointment as Renault CEO in 2020 sent him back to where he started his career. Luca De Meo, welcome to Bloomberg. And I say all of that because it's a strange time in the auto industry now, given the chip shortage, and of course your experience means that you have a very unique view of this. Just how acute is the chip shortage, and how long do you see it lasting?
Good morning, Danny. Unfortunately, it's 30 years of experience. I'm getting old, not 20, as you said, unfortunately.
30.
So of course, this issue of semiconductors is annoying, everybody in the automotive industry. You've seen some of the declaration of my colleagues. The good news is that despite the fact that we had a higher impact that we initially anticipated, the results of Renault are completely on track with our plan. So we're back to profitability. So this is certainly good news. And we actually anticipated at the beginning a recovery already from quarter 3 of this year, but now that we are in, we see that there are the difficulties and the problem continue, and we are maybe seeing a recovery on Q4. That means that we won't be able to catch up and get back to the 100,000 units losses that we planned at the beginning. This is basically the situation, but we will endeavor this supply chain constraints, and we'll try to continue to stay at this level of profitability this year. This was at the end of the message in our guidance in the analyst conference this morning.
So Luca, just be clear. So the chip crunch perhaps clearing up in the fourth quarter. Of course, we still have issues of the Delta variant COVID spreading. What are the risks to that outlook specifically?
I think that two of them you mentioned, the chip shortage will continue probably throughout, I would say maybe first semester of 2022. We'll have some, let's say, some fluctuation, some uncertainty and lack of visibility. We have, of course, the pandemic is not completely over, especially in some markets where we have in the supply chain production capacity for some of the components. We're seeing that, for example, in Malaysia having impact on us. And there is another thing that will probably hit the industry more on the second semester, which is the growth of raw material price that is kicking in right now, which we anticipate in the order of 500 to 600 million euro for Renault. But this is part of the calculation in our guys, though everything has been integrated, and we say that we try to stay at least at this level for the end of the year, which, by the way, 2.8%, let's say, operational margin is what we promised to the market by the end of 2023, and we are achieving that level, with 2.5 years of advance. So we keep fighting. It's a very challenging environment, but that makes the thing interesting.
Right, and one of the challenges, as you mentioned, of course, is that raw material price increase. How are you passing those prices along to customers?
Partially, we have already anticipated this thing, but it's also part of a strategy of improving the quality of our sales, which had a huge impact on our capacity of, really showing an improvement on net pricing. For your reference, compared to last year, we were up 8.7% in average in terms of net pricing at Renault, which is a pretty remarkable performance. But it's not only justified by the fact that cars are getting more content and raw materials are increasing their prices, also because we decided to abandon some unprofitable channels, markets, models, because we put focus on value creation and kind of abandon the approach of only looking for sheer growth, because that was bringing the company in a very complicated situation. Don't forget that last year we lost many billions of euro, more than 7 billion euros, and so this is we are actually back from hell with this let's say first semester, and it went quicker than we anticipated, which is a good news.
Well, I know in your strategy update in January and earlier this month, you also expressed a desire to get into the Chinese market as well. Are you concerned, considering some of the latest clampdown from the Chinese government? Does that change your strategy to expand beyond Europe at all?
Well, I think that China is the biggest market in the world. We are almost nowhere there, if I would say, because we kind of decided last year to completely change the strategy. But I think that a global brand like Renault without a presence in China is not an acceptable concept. But we have to find a way to get back in a different way, with a proposition that is more progressive, and adding something to the equation. So we are not going to try to come in the traditional way, also because I think that China sets a lot of trends in the automotive business, both from a consumer point of view, also from a technology point of view. So being there means staying very close to the real evolution of the automotive market. It's very, very important. But we'll come with maybe some ideas and some plans when the time comes.
I mean, do you think it's fair to say that, the reliance on Europe has to kind of be overcome in order to maybe catch up with some of your rivals like VW, for example?
Yeah, for sure. We are actually 50-50 between Europe and international markets. So naturally, Renault is a company that's made its internationalization process already starting in the 90s. So we are not completely unbalanced, but we don't have the US market, and right now we don't have the Chinese market. So for sure, there is the ambition to get back to a global footprint, but we have to do it right at the right time with the right approach, and that's what we are working on.
All right, Luca, thank you so much for joining us this morning. That's Luca De Meo, CEO of Renault, with 30 years in the industry of experience, I should say. Now, coming up 1 week into the Tokyo Olympics, the host nation is second in the medals table, but importantly, the public is changing its mind about the games. We'll get the latest from the Japanese capital. This is Bloomberg.
if inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, the first week of Japan's Olympics is coming to a close, and the host nation is currently second on the medals table. Some of the stories of the week, Suni Lee's victory in the all-around gymnastics event following Simone Biles' withdrawal, the tiny island of Bermuda claiming its first ever gold medal in the triathlon, and two 13-year-olds from Japan and Brazil taking gold and silver in the women's skateboarding. I love that. Love to watch skateboarding. But controversy has also followed the Tokyo Games. But 1 week of top-tier sport, is it starting to change people's minds? Joining us now to discuss is Grace Wang, our reporter in Tokyo. All right, so Grace, is that fair to say? Is there a change in opinion about hosting the games in Japan?
Yeah, actually, I see a gradual change, especially if you are analyzing the Twitter tweets. Then you will see about actually positive comment toward the game improved about 10% compared with before starting the game. So I definitely see there's improvement. And I think there are several reasons for this. One is that people towards the opening ceremony, there were events to sort of like cheer up the games, such as Japan's self-defense force had its aircraft acrobat team to perform fly through the sky, and the fireworks at the ceremony. These things are really making the Twitter into people's tweet. So these are the positives, and with more gold medals, Japanese players bring back home and share that excitement with people. You can see citizens are posting more positive comments toward this game.
And how well is Japan containing the pandemic as the game goes on? And quickly here, Grace.
Yeah, actually, it hasn't been while Tokyo has been, has hit record high in newly found cases. So far, the Olympics Village has been able to contain the virus fairly well compared with the rest of Tokyo.
Grace, thank you so much. That's Grace Wang, our reporter in Tokyo, keeping track of the Olympics for us. And we are just seeing a market continuing to end the week on a very sour note. Stock 600 down 0.5%. And we're going to continue the market conversation on Bloomberg Surveillance Early Edition in the next hour. Matt Miller and Kaylee Lines, both in New York. They will join me from there. Along with the market action, we, of course, have a lot of earnings to get through. This is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance and more.
2022年完成空间站的在轨建造，建成国家太空实验室。之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station. China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
It's a long-term focused company, and we're making decisions and making big bets with the long-term interest of the business in mind.
There is an overall way of handling through digital, through the way of handling and the vaccination that we anticipate that rebound will crystallize.
Businesses have been remarkably resilient. There's a lot of support still in the economy, but as we come out of lockdown, confidence is coming back.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, July 30th. Our top stories today: Amazon's pandemic profits may fade away. Vaccinated shoppers are now starting to brave the great outdoors. Rough opening for Robinhood. Shares of the popular trading app fall flat in their debut. Presidential power hits a wall. Why there's only so much Joe Biden can do to fight the pandemic. I'm Danny Berger in London alongside Matt Miller and Kaylee Lines, both in New York. Francine Lacqua is off this week. And Kaylee, it is a risk-off day to end a very volatile week.
Yeah, it is, Danny. We definitely saw that playing out in the Asian session, even with news out of the China Politburo that they are going to improve supervision on overseas listings. Not yet clear what that means, but we'll have more on that in just a moment. Broadly, though, stocks were lower in Asia, including in China, and the Nikkei was down about 1.8%, the Hang Seng by 1.4%. And the Hang Seng Tech Index, which has seen an incredibly volatile week, also saw that dip buying really stalling out. That index was down about 2.5%. One individual stock to keep an eye on from the Asian session is China Evergrande, of course, the indebted property developer that has been in some trouble as of late. A court freezing assets for its listed onshore subsidiary, so that stock fell about 8% in the Asian session. And in FX, your big underperformer in Asia was the South Korean won, weaker against the dollar by about 1/3%, just around its weakest level in about 10 months. Here in the U.S., of course, we saw that second quarter outlook, or the outlook for Amazon really missing expectations after the bell last night. That is dragging heavily on futures, most notably the NASDAQ 100, with futures down more than 1 percentage point. We are seeing yields tick lower. The 10-year Treasury yield down about 2 basis points. We're sitting south of 125. And I would note the Bloomberg Commodity Spot Index is back at its highest level since 2011. Part of that is due to higher crop prices because of the weather, but part of that story too, Matt, is the weaker dollar. The dollar weaker for a fifth day, heading for its worst week since May, Matt.
Yeah, you know what? I feel like that's kind of an up arrow story. There's a little bit of risk on sentiment. You can see it play through in the dollar. You can see it play through in bond yields as well, because we have some positive news. European GDP just crossing the Bloomberg terminal right now, a gain of 2%. The estimate was for 1.5%, so better than expected. The same is true with European inflation at 2.2%, better than expected, and up there where the ECB wants it to be. There were some disappointments if you look at individual countries. For example, Germany only had GDP growth of 1.5%, and we were looking for 2%, but Italy had 2.7%, and Spain had 2.8%, so big, strong growth in the periph. Let's take a look at what's going on in the markets. As I said, you get a little bit of a risk-on feel from the German Bund. It's coming back, still negative 44 basis points, but at least it's gaining. The pound is gaining as well. The euro is up, powering through 119 as the dollar weakness lets those currencies come up. And then you've got some positive stories. Unicredit, for example, in Italy had double the profit that it had last year, beat the street's estimates, lifted its forecast for, or rather reduced its forecast for the reserves it needs to hold for bad loans. So that's an up arrow story. So there are good things going on across Europe, even though it looks like a little bit of an equity sell-off, Danny.
Yeah, Matt, that banking story really strong there, releasing loan loss reserves. Seems like we've just skipped the credit default cycle.
Yeah, absolutely. And you had other good stories. Schneider Electric raised its forecast in France. EssilorLuxottica raised its forecast as well. So there are some good earnings stories out of Europe.
Yep, the beats, they keep on coming out of Europe, Matt. Now look at what's ahead today. We'll get the data out of the U.S. at 8:30 a.m. New York time. That's going to include personal income and spending rates, along with PCE inflation. Then later at 1 p.m., Baker Hughes releases its U.S. rig count, and we'll also get more earnings, this time from ExxonMobil, Chevron, and Caterpillar, that big bellwether stock. Now, we also have a China Politburo meeting taking place in China with President Xi on Friday about the second half economic work. A lot of headlines coming through out of that, including their supervision system for listings overseas. Joining us to discuss is John Liu, Bloomberg News executive editor of Greater China, joining us from Beijing. John, what are the big takeaways so far with what we're hearing out of the Politburo meeting?
So I think it's important to say that the Politburo is the 25 most powerful politicians in China getting together. They have a meeting a month. It includes Xi Jinping, it includes the Premier Li Keqiang, it includes Liu He, Xi's chief economic aide. And what they've decided is that they will improve, and I think that is a euphemism for increased scrutiny of overseas listings. That's obviously been in the headlines with Didi, with what's happened with the education tutoring companies. I think this is a sign that that scrutiny will continue into the second half.
All right, John Liu, Bloomberg News executive editor of Greater China, breaking down that breaking news story. Thank you so much. Now let's turn to Amazon. It appears the company's pandemic bump is fading. The world's biggest online retailer missed quarterly sales estimates for the first time since 2018. Joining us now is Bloomberg intelligence analyst Matt Bloxham. Matt, what do you make of this miss right now?
Yeah, well, I mean, it's quite a dramatic slowdown in sales growth. You know, they're talking about 10 to 16% growth for Q3. The market was looking for 20%, and that's after in Q1 they grew at 44%, and the quarter just reported Q2 they were 27%. So a really dramatic slowdown. You know, people are out in the streets buying stuff from real shops. And the CFO was quite cautious about telling people that you should expect that muted growth for some quarters to come, both as they kind of lap very strong quarters last year, but that this kind of return to the old normal carries on for some time.
That's kind of a bummer. I thought a lot of this shopping was going to be sticky, Matt. I mean, we've signed up for subscriptions. We're used to not having to lug, cases of Gatorade or beer or whatever, I don't know what you can buy on Amazon in this country, back to our apartments. So we have it coming. Why isn't it as sticky as it could have been?
I think it's a complex story, and I think that there definitely is a lot of stickiness, and I think the future trend is.
Oh, it looks like we lost Matt Bloxham of Bloomberg Intelligence there, but breaking down the miss on the forecast from Amazon for us. Now let's turn to Robinhood, ending its first day as a public company 8.4% below its IPO price. This is after it failed to win over retail investors. Vlad Tenev, Robinhood's CEO and co-founder, spoke to us yesterday.
We certainly are proud to have one of the largest retail allocations ever. And the way that we think about it is it's a long-term focused company, and we're making decisions and making big bets with the long-term interest of the business in mind.
Let's get more on this with Sonali Basak, our Wall Street reporter. So Sonali, Robinhood rejected by the same people who use Robinhood.
Yeah, in essence, right? They made 35% of their shares available in this IPO to retail investors. Only about 20 to 25 picked up on that.
Still a big number.
It's still a huge number, exactly. And if you look at the numbers, Robinhood today at $29 billion is still worth more than Credit Suisse. It's worth more than Interactive Brokers. It's 3 times as expensive as last year's earnings than Interactive Brokers and Schwab. So the IPO itself, you never want to see an 8% drop in the IPO. That's the worst ever for a listing of its size. It reminds me of Uber, where also there was a drop. The underwriters were blamed pretty immediately for it. And, Matt, you were asking all of yesterday, what does this mean for future performance? Uber is actually today starting today below its IPO price.
But it did actually rise. It just took a long time for Uber to recover from that. The same is true of Facebook. They had a pretty disastrous first day, and it took, I don't know, a year before they really came back. I think one of the most interesting things is that the underwriters made some shares available to short. There was the option to do that, and there's a debate on the street as to whether or not that's a good strategy. Some people say why that could bring the price down. Others say it gives you a little bit of cushion because when the stock falls, those shorts cover and you can turn the momentum around.
It's really interesting. This, in the weeks into the IPO, was a big source of conversation for investors and underwriters. When this happened with Lyft a while back, a lot of scrutiny around this, a lot of investors upset about it, but some who were able to gain from it, right? It seems like the perception around this, at least from the banking community, is starting to change, that maybe it should be made more available for different reasons for price stabilization. With that said, this is a retail stock as well, with a lot of retail interest who do not like short sellers.
But if you can only buy and you can't sell, that's a problem. Remember, that's why retail investors are so angry at Robinhood, because for a while they didn't allow them to sell their GameStop shares.
Would love to see you personally duke it out with a retail trader on this now.
I am a member. I am one of the degenerates there on Wall Street Bets. Sonali Basak, thanks very much for joining us on the Robinhood story. President Biden now has made it officially announced yesterday that he'll require federal workers to prove they're vaccinated against the coronavirus, or they'll have to wear masks and submit to frequent testing. Let's listen in.
Every federal government employee will be asked to attest to their vaccination status. Anyone who does not attest or is not vaccinated will be required to mask no matter where they work, test 1 or 2 times a week to see if they've acquired COVID, socially distance, and generally will not be allowed to travel for work.
Joining us for more is Emily Wilkins, Bloomberg government congressional reporter. So he doesn't quite go all the way. I mean, he's not really requiring that you get a vaccination. You just have to mask and test if you don't.
Right. This isn't exactly a vaccine mandate here from the White House, but it is a bigger push that is coming at a point where the White House has sort of really been stuck. You know, initially for the first 6 months, we were seeing the rate of vaccinations really go up and up and up every day, peaking around April. But the Biden administration did not make their goal of getting at least 70% of American adults having at least one vaccination before July 4th. And since then, they've really been struggling trying to get the unvaccinated population to consider getting a vaccine, despite the fact they are so widely available in the U.S. President Biden also called on states to use funding that they had received for the pandemic to use it to encourage individuals. He suggested states give individuals who are not yet vaccinated $100 if they go ahead and get that vaccine.
Emily, another plea Biden has made is about this eviction ban that's up to expire soon. He's asking Congress, don't let it expire 2 days before it does. Is that enough time to get this ban extended?
It doesn't look like it at this point, but though Congress is certainly trying, Speaker Nancy Pelosi is working to attempt to potentially today move legislation that would expand that eviction moratorium until the end of the year. It's not yet clear if they're going to have the votes to do that. And then, of course, it's even a more tricky question when you get to the Senate. I mean, at this point, it looks like you would need all senators to be in agreement on it to pass it quickly enough to get it done by the time that that eviction expires on July 31st, tomorrow. And so it looks like this is something congressional leaders are going to attempt, but it also doesn't seem that they really have the timeline here to be successful on this. The White House really only requested yesterday that this eviction moratorium be extended. And in a body like Congress that moves as slow as it does, that's often not enough time.
Millions of people could be facing a very harsh reality tomorrow. Emily Wilkins of Bloomberg Government, thank you so much. Getting back to the markets now, I want to take a quick check on some stocks moving in pre-market trading in the U.S. And the big underperformer is Pinterest, down a whopping 18%. Kind of a similar story to Amazon in that its pandemic boon seems to have ended. It actually lost 24 million users in the second quarter, leading to that plunge today. Also, that Amazon forecast miss is weighing on some other e-commerce stocks, one of them being Global E-Online. It's down about 5.3% before the bell. One stock moving to the upside, though, is Atlassian. It is a software company, and it's really benefiting from its shift toward the cloud. That led to a better outlook than expected, and as a result, that stock is up in early hours, Danny.
Definitely one of the bright spots of this pandemic-related earnings season. It's all about the cloud, Kaylee. Now, coming up, we get more into this earnings season with Patrick Armstrong, Plurimi Wealth CIO, and later, we also have an exclusive interview with Air France KLM CFO Steven Zott. This is Bloomberg.
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
We've got some breaking news now out of China. We told you earlier the Politburo has met and has some regulations, some advice for business there, and now they're saying they're going to deepen their anti-monopoly supervision of ride-hailing companies. Now, that's pretty specific, but it does feed into the general concern about more regulation, snap regulation in China, and begs the question, why would a Westerner invest here? Is it uninvestable at this point? Joining us now is Patrick Armstrong. He's the CIO of Plurimi Wealth, and I guess that's a pretty strong statement or a pretty strong question, Patrick, but when you have these kind of moves, you're reminded it's a communist country led by really one person. Is China investable in your opinion?
It's probably going to become investable right now. I think it's there's some companies you definitely want to steer clear of. We still have a position in Tencent that we've held for most of the year, that maybe you can call it 6 cent now after the performance, but incredibly cheap. If it was left to its own devices, the rule of law would apply and market dynamics would determine its profitability, but that's really not the case. So I'm continuing to hold it on its valuation, expecting there will be almost an end game from China where we'll have a little more clarity on what they're trying to achieve. They're definitely trying to disrupt any companies that have monopolistic characteristics, and Tencent's one that we own that probably falls into that basket. On the other side of things, we've been playing it. We're currently short Meituan. We've been short Tal Education that we just closed out after its big share price collapse. But it's difficult, but valuations are there, but it's unpredictable as well.
So let's talk about some stocks, tech stocks here in the U.S. that are decisively not cheap. Do you want to own mega cap tech right now, Patrick?
They're great companies, no question about that, but I don't think the leadership's going to come from tech anymore. I think you want to be in cyclical growth if you want outsized returns, if you want stable companies that are trading at premium multiples that probably are fairly valued. I think that's what tech is right now. So Alphabet had a great quarter. Facebook had a great quarter. Stocks really didn't move on incredible results. If you look at consensus ratings for these companies, Amazon, 55 analysts cover it. 54 of them had it as a buy going into last night's earnings. On Alphabet, very similar ratios.
Yeah, Patrick, I mean, if you think about what's been happening in markets in terms of what people are investing, I mean, passive is so massive at this moment. How acute is concentration risk when we start to see some of these big cap tech stocks sell off when so many people own them through passive vehicles?
Yeah, passive is 25% of the S&P is a lot of these big cap tech companies right now, and retail investors who are the other force. You've got passive investors and retail investors are the driving forces of markets right now, and they're all attracted to these companies because they use them every day, they understand them, and you've never really had many negative consequences to owning them. So I think Amazon, you're going to get a bit of a shakeout today, and it is incredibly concentrated. These companies haven't let people down for years and years and years. They've delivered outsized returns. There's massive amount of profits that will be booked, I think. And my view is that we're going to have a continued reflationary backdrop. And companies like ArcelorMittal, which reported yesterday, had great earnings, a great forecast. Facebook had great earnings, lowered its forecast. ArcelorMittal is trading at 3.5 times forecast earnings.
Patrick, there's always a little bit of trepidation when we're bouncing around all-time highs like this, when we see valuations rise like this. But will we grow into it, do you think? Are all-time highs bullish?
For me, the biggest risk for markets are the multiples. I think the earnings growth is going to be strong, liquidity is going to be strong, negative yields, all of that supports markets. Tapering is going to happen, and I think there will be some multiple contraction, but I think earnings growth will offset that. That's why we're really positioning into companies that are growing earnings but aren't trading at record multiples. And I think you're not going to have a collapse of these companies, but I think it's going to be a pause where basically the earnings catch up with the market cap valuations. So I'm not really worried about equities. Liquidity, negative real yield, strong economic growth. As long as those three pillars remain in place, I think the path of least resistance is higher equity prices.
All right. A little hint of bullishness there to close out your Friday. Patrick, thank you so much. That's Patrick Armstrong, CIO at Plurimi Wealth. This is Bloomberg.
What you said was we need to make them in America. Does that include overseas companies making them if they have the plant in America?
I would certainly be in favor of them having operations in America, absolutely. You know, Samsung, TSMC, there are companies that are in allied countries, and you know, we certainly want them operating in America and producing chips in this country, yes.
So we have a significant chip issue, but there are other supply chain issues as well. As I know you're monitoring what's going on. Where have you seen other problems in the supply chains right now in the United States that need to be addressed?
Particularly in home building supplies, you know, lumber and all the related supplies, glue, adhesives, and you see it playing out. You know, home prices are high. If you go to Home Depot or Lowe's, you'll see prices are a little bit high, and that's all because of the lack of supply, just disruption.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Danny Berger in London. Francine Lacqua is off this week. Now let's get the first word news. And in Hong Kong, a protester has been sent to prison for 9 years in the first ruling involving that sweeping national security law imposed by China. The man was convicted of crashing his motorcycle into police officers while flying a protest flag. There's a new report about just how bad the coronavirus's Delta variant really is. According to the Washington Post, it appears to cause more serious illness and spreads as easily as chickenpox. The Post cites an internal CDC presentation which says unpublished data show vaccinated people infected with the variant may be able to transmit the virus as easily as the unvaccinated. In the UK, the signs that the so-called pingdemic is starting to ease. That refers to the official mobile phone contact tracing apps that ping workers and tell them to self-isolate. One reason may be that infection rates are falling, or people could just be deleting the app. And for the first time, Germany will allow certain institutional funds to invest billions in crypto assets. So-called special funds with fixed investment rules may out as much as 20% of their assets in Bitcoin and other digital currencies. The funds can only be accessed by investors such as pension companies and insurers. And coming up, Air France reporting optimistic earnings as travel continues to pick back up. Our exclusive interview with the CFO is next. This is Bloomberg.
E3 is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Matt Miller and Kaylee Lyons in New York. Francine Lacroix is off this week. Matt, look, I know it's been a volatile week, but I'm sorry, the story gripping markets is Scarlett Johansson suing Disney because they streamed her Black Widow movie the same day that they also had a theatrical release, which means she had less profits.
Yeah, well, I mean, she did already make $20 million, but I'm kind of on her side on this one. You know, Disney has been doing this with a number of releases, and I believe they've actually settled out of court with other actors on this issue. They're streaming even though they promise in the contract to give a theatrical release first, and typically in the industry, apparently, that means 90 to 20 days in theaters. Now, they've hit back pretty hard at Scarlett, saying that basically she's heartless and doesn't care about people affected by COVID, but I think that's kind of a cop-out.
sad and distressing in its callous disregard for the horrific and prolonged global effects of the COVID-19 pandemic. That was their response.
It's business, Disney.
Yeah, all right.
They know it.
Yeah. It seems like a bad idea to pick a fight with a celebrity. Kaylee, are the markets just selling off because everyone's sad for ScarJo? Is that what's happening?
I mean, I don't think that people don't care about ScarJo, but I think they care about her less than other things that are going on today, Danny. It is a risk-off tone in markets really across the world. Part of that has to do with Amazon with a really disappointing forecast, and that's dragging on tech specifically. In Europe, we are off session lows. The stock 600 down by about 0.5% or so, but almost every industry group is in the red. And here in the U.S., it is NASDAQ 100 futures underperforming. They're down more than 1 percentage point. You are seeing a bid coming into the bond market, down 2 basis points on the 10-year yield to south of 125, while the Bloomberg Commodity Spot Index is at its highest since 2011. Now, I mentioned Amazon with that disappointing forecast after the bell last night. It seems the pandemic boom for the company may be coming to an end with growth set to slow. That is dragging the stock down 6% in early hours and dragging on some other e-commerce stocks as well, one of them being Etsy. Biggest plunger to the downside in early hours, though, is Pinterest. It lost 24 million users in the second quarter, and as a result, that stock is down a whopping 20%. And then finally, Robinhood, of course, the big debut of yesterday, not greeted kindly by the public markets, Matt. It fell 8% yesterday. Looks like that will continue today. The stock down more than 1% in early hours, Matt.
Do you know, I'm going to walk over to this chart because I feel like it's easier for our radio listeners to understand these charts when I physically walk them through. Welcome our listeners on London DAB digital radio every day at this hour. I've got here a chart of jet fuel over the last 2 years, and you can probably guess what it looks like even if you're not watching us on TV. It drops drastically as we go into the COVID lockdowns in March of 2020. And then it spikes a little bit after we thought maybe in the summer last year, is this over? And it kind of flattens out, but now it's been rising. Jet fuel demand is really climbing because travel is coming back. First off, it's just the leisure travel, or leisure as Danny's friends in London would say it, but soon enough, business travel is going to come back, and it looks like the market is prepping for that. Joining us to talk about this is Steven Zott. He's the CFO of Air France KLM. They had great numbers in earnings today, and I want to just ask first off, Steven, when is business travel coming back? Do you see it coming back in certain regions, and how important is that to offsetting these gains in jet fuel prices?
Good morning, everybody. Thanks for that question. If you look at business travel at the moment, we are still having business class passengers in our plane. So it is not that the business is over. We see actually an increase of demand probably in the future for leisure business demand, because I think more and more people are interested in that product. It's very difficult to already forecast now the exact levels, because actually due to the COVID crisis, people are still not fully back in the office, and as people are not back in the office, they are not traveling yet fully for business travel. But still, especially on the segment which we sometimes forget, which is the small and medium-sized enterprises, you see that the business traffic is still in because they need to visit customers or they need to visit their plant.
How long will it take to see a full demand recovery in that segment, though?
That is very difficult to tell at the moment. Of course, in the future, there will be maybe an impact for the people who are working from home. But at the end of the day, I've been here already in the airline industry. When they start video conferencing, everybody told us that there will be a reduction of demand of business travel. It didn't happen. We had the same question after the credit crisis. Everybody said it's over with the business travel. It didn't happen if you look at the numbers, for instance, in 2017. So people are more human than we think, and there is a big need to see each other. So let's wait for it. And at the end of the day, we can always reconfigure our planes for it if necessary.
Of course, one hurdle to that, to getting back to normal, are U.S. travel rules. On the call, Ben Smith, your CEO, talking about Air France asking for that reciprocity from the U.S. How confident are you that you will get the U.S. lifting some of its restrictions from traveling overseas?
Yeah, let's first start that we are very happy that people from the US can travel into Europe who are vaccinated. And we've seen that already, that we could increase our capacity and increase the load factor from the US, which is a crucial market for us. So I think that was a very positive sign, and we have only now, let's say, 50% of the market traveling, and we are already at load factors of 60%, which usually is maybe not that good, but given the current cargo prices, it gives a big contribution, a flight contribution to our profitability. Of course, it's crucial that also the US opens to the EU, and we are hoping for that will be soon the case, that vaccinated people get into Europe from the US, because I think there's no reason that vaccinated people could not travel.
Let me ask you a speculative question here. If you continue to see problems with travel restrictions, if we continue to see flare-ups of COVID and business travel doesn't come back, do you have a plan to offset that revenue stream? Because it's pretty important to your airline, to all airlines.
Yes. Yes. Now, let's say what we see is that there is a big appetite to travel. So everywhere where people can travel, we see immediately bookings coming in. And you have seen our very high level of ticket sales in the second quarter, which supported that we, at the end of the day, were cash flow positive for the first time since the crisis. What will offset a part of the loss of the normal traffic is the very strong cargo. Because if there's less passenger business in, we can fly more cargo planes. So that's the first way to offset it. And at the end of the day, for our subsidiaries or for our airlines, Air France and KLM, we have still furlough systems in place, and we are still busy to restructuring our company. So we are offsetting it in the cost.
Well, I just want to say, yesterday I was talking to Guillaume Ferret, and he's talking about, you know, the new A350 wide body, making that into a freighter. Would you be an inaugural customer for Airbus's A350? Is that a possibility?
We are looking at all possibilities of fleet, of course. We are not an operator of a big freighter capacity. So what we are doing, we have a very strong and global network, and we have a lot of belly capacity in our passenger business planes, and we support that by some freighters. So we have some freighters in Paris. We have only 2 now in Paris. We had up to 3 to 4 in Amsterdam, and we use those freighters to support our activities at the belly, and we are currently investigating what we could do to actually take advantage of the current market conditions. But we don't talk about a number of planes. It is maybe we talk about just 1 plane to support our belly capacity.
When will you get a new age package from the Dutch government, Steven?
So there are currently discussions with the European Commission, which are going in the right direction. I cannot give any specific date at this moment, but we are very close working to the Dutch state, because it's actually a discussion between the Dutch state and the European Commission.
Steven, thanks very much. I suppose if I asked where you were going with your new order for 160 planes, you wouldn't tell me. Does Boeing or Airbus have the edge on that?
I cannot give you any answer on that. We love both manufacturers, and we are looking forward for the prices we get for this order.
All right, you know I had to try, Steven. Thanks very much. Hope we can get you back on the program. Steven Zott there is the CFO of Air France KLM. Now coming up, Robinhood's disappointing debut, the trading app failing to win over some of the very retail investors it's courting for long-term growth. Maybe you expected that after the GameStop saga. More next. This is Bloomberg.
anos sem se apresentar, as escolas estão começando a reabrir, os teatros não vão reabrir tão cedo. Aí a gente teve a ideia, no melhor estilo Minuto Nascimento, vamos levar a música aonde o povo está.
Minha missão hoje é fazer as pessoas sorrirem, cara. Sorrirem, olharem da janela, verem uma coisa inusitada, ficarem felizes, mandarem pros amigos e, enfim, curtirem um momento diferente, mesmo dentro de casa.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Is Bloomberg.
It's really humbling that 6 short years after we launched our product to the public.
Hello traders, I'm going to place an order to sell short Japanese yen. Okay, the price I'm looking to sell 109.540. Okay, if you're looking to trade today and if you're looking to trade Japanese yen, here is your chance. I'm placing an order to sell short Japanese yen, so stay with me. Follow my trades, and we will go through until the end, and I will guide you through until we will close this position in profit. Okay, looks like you still have time, so I'll speak to you later after we'll get filled.
So volatility, comes and goes, and we're not going to be commenting too much on daily fluctuations of the stock price.
That was Vlad Tenev, Robinhood CEO and co-founder, speaking to Bloomberg's Emily Chang yesterday. Of course, the trading app went public, debuted yesterday, and recorded the worst one on record for an IPO of its size. Joining us now is Barry Ritholtz, Bloomberg opinion columnist and Ritholtz Wealth Management Chairman and Chief Investment Officer. Barry, I just want to get your hot take. What did you make of Robinhood's debut yesterday?
Well, two things. First, the shorter term issue is clearly they were a pandemic play with people home and bored. And as the world began to reopen, there's less of that. There's less boredom trading, casino. Instead of Vegas, let's play with our Robinhood app. But the bigger issue, the structural issue, is companies have been staying private for longer. Every time they do a round, their valuation goes up. And it's pretty clear that this valuation reached a point where there was no appetite for it amongst public investors. If you're going to stay private that long and have your valuation far exceed your competitors, well, don't be surprised when there's no IPO pop.
Yeah, much has been made of retail investors kind of poo-pooing the IPO, the first day of trading, although it should be mentioned, of course, that I think like 25% took shares pre-IPO. I wonder what the institutional view of Robinhood is, Barry, because no matter how you see it, even if you're unhappy about the gamification of investing, this is a game changer in so many ways, right? I mean, they changed the way institutional investors short stocks. They certainly changed the conversation on pay for order flow. They changed the way Gen Z is investing. No, you're shaking your head. No, no, no.
I'm on the other side of the trade on most of that. So first, it resurrected the debate about payment for order flow. But when we see surveys of investors, hey, which would you prefer, payment for order flow, or do you want to pay a commission up front? And the vast majority of investors would rather have it be invisible and not see it. Payment
and
for
cheaper,
order flow.
frankly,
You and I,
and cheaper.
We've discussed this. It narrows spreads. Somebody's got to pay for that massive infrastructure. If it's not a commission, it's going to be paying for overflow. Number one. Number two, I don't think so. So what you could give credit to Robinhood for is doing what Chuck Schwab forecast 40 years ago, 30 years ago. In the early 90s, Charles Schwab, I think it was his first biography, said he thinks eventually trading will become free. And that turned out to be true. Robinhood has been doing this since 2015, free trading. But it wasn't until Schwab came out and announced 2 years ago, hey, we're going to buy TD and become a massive custodian and broker, that really free trade went everywhere, reverberated throughout the market, and it forced everybody to up their game and to look.
Okay, guys, as you can see, position opened on Japanese yen at 109.54. You can say like that. You still have time. It moved up. So all of you guys who want to trade Japanese yen, stay with me, follow my trades, and we will close this trade in profit. I can't tell you how long it will take us to hold this position, but I know for sure that we will make profit from trading Japanese yen. I'll speak to you later, guys.
And I say this as someone who was short a lot of the stocks that imploded in 0809, and watching those last few dollars below 10 was a nightmare because it's so squeezable, even as these companies were going out of business. Don't short stocks under $10 that have collapsed 90% and have a massive outstanding short interest. That's the takeaway. The fact that a bunch of people figured out, hey, we could do this with options and create a gamma squeeze beyond just a regular short squeeze. You know, people have been taking pot shots at shorts for a long time. Look at what took place with Bill Ackman and Carl Icahn when he realized, hey, here's a massive short position, and if I could get a little momentum, we'll squeeze that up and move the stock higher.
Barry, can I play devil's advocate for you a little bit? Okay, maybe this isn't a new phenomenon in terms of you don't want to short anything with a massive short interest, but if you look at the attitude of a lot of these people, I mean, Matt Miller is over there on Wall Street Bets. It's all about diamond hands. You hold, you brag about your losses, you don't give up. I mean, who's to say that this isn't a just big shift, maybe a generational shift of people who get passionate about companies? I am signed up. I am signed up. I figured. Yeah. So, I'm not going to disclose
there's 11 million degenerates on there.
We're all degenerates.
So first, there's nothing different between this and what we saw in the 1990s with the Yahoo message boards. iOmega is the poster child of diamond hands, where individual investors were literally driving out to the company's parking lot on a Sunday afternoon, and hey, it's full of cars. They're working triple shifts, and eventually, you know, the investing public was way ahead of the Wall Street analysts. But, you know, you could show me a handful of companies where the public can get ahead of Wall Street on stuff like this. Let's not forget, there are tens or if not hundreds of billions of dollars at risk, thousands of very smart people, really highly equipped with the greatest technology and, you know, a really amazing infrastructure. It's exceedingly difficult to beat that crew on a regular basis. So let's just be wary of extrapolating from a handful of companies. Hey, I find the Reddit phenomena fascinating, and it's, you know, it's not, I don't think Vanguard or BlackRock are losing sleep over a handful of narrative-driven stocks that have done really well, pushed by Reddit.
Barry, unfortunately, we're out of time. Great to have you on this. That's Barry Ritholtz, Bloomberg opinion columnist and Ritholtz Wealth Management Chairman and Chief Investment Officer. This is Bloomberg.
to Maine and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astercoma carinata.
I nailed it.
It's not thera, whatever. Astercoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
What we're seeing is a good recovery in the economy as we open up, so we're cautiously optimistic about the recovery, but strong performance across all of our businesses driven by an increase in lending with mortgage growth. The mortgage market here remains very strong. And as we come out of lockdown, consumer spending is starting to recover back to pre-COVID levels, and our commercial business continues to provide strong support. So what we're seeing is, very low level of defaults. Businesses have been remarkably resilient. There's a lot of support still in the economy, but as we come out of lockdown, confidence is coming back and we see more optimistic outlook for the economy and very low levels of default. But, a strong and resilient performance. And obviously we have a very strong capital position, a capital accretive position. So that allows us to pay dividends and capital distributions to shareholders.
Good morning, Alison. As you said, it's some great results across the board there, and I can see that there's a plan of a £750 million buyback in the second half of this year. If the next quarter is just as strong and you continue to accumulate these excess capital, what will you do with that excess capital? Will you accelerate buyback programs further beyond what the government's directing, or will you turn to M&A or some other way of returning capital to shareholders?
Yeah, we've set a medium-term target to be at a 13 to 14% CET1 ratio, which is the right shape for a business like ours with very good risk diversification and a balanced book. So we have a clear path, and my clear preference is to distribute capital to shareholders, but also to continue to invest for growth within our business, and we're seeing good growth across that and potential for more organic growth. And then we will also consider any other options that add to shareholder value. But I think hopefully what we've given to the market is a clear indication of a steady capital return. We're investing $3 billion into the business for growth over the next 3 years in our digital transformation, and we will always consider options that add shareholder value as well.
What are NatWest's plans for office space if work from home or at least a hybrid structure is more the future? Will you keep your Bishopsgate campus and your Edinburgh campus?
Yes, we will keep those two campuses. I mean, we're evolving our working into a more hybrid way of working. I think certainly COVID has busted a few myths about how you can work. We were able to get 50,000 people working from home and continue to support, good operational performance and customer support during that period. So our offices are evolving into more hybrid spaces, more flexible working, but there will always be a need for offices. There will always be a need for collaboration and bringing people together. So our footprint will evolve, but our two big campuses are not going to change.
All right, so the Bishopsgate campus is safe. That was NatWest CEO Alison Rose speaking with Bloomberg's Mark Cudmore earlier today after the company beat earnings forecasts in the second quarter. Bringing it back to New York, Danny, I will be back in New York next week. I'm staying. I was going to go back to Berlin, but I figured, the action is here, so why go back?
Perfect time for you to check out that frothy housing market in New York, Matt.
Yeah, I'm going to look in Bronxville. Actually, if any viewers have a place in Bronxville for me, go ahead and shoot me an IB. Coming up, Jan Hatzius, Goldman Sachs chief economist. This is Bloomberg.
week on Bloomberg Green, the rise of green finance.
What we're trying to do is to have a positive impact in every investment and to future-proof those investments.
2021 is the year of sustainable finance, but how do we make sure that all of this money is as green as it's supposed to be?
We know the direction is clear, but the road will be bumpy.
The European Union lays out the green standard for bonds, tightening up rules for banks on climate change.
We see a real link between the impacts a company makes on workers and society and the community, but also on climate and the environment, on the long-term financial value of these companies.
And turning money into motion, the story of how one small activist investor took on an oil giant. I'm Danny Berger in London, and that's what's coming up on this week's edition of Bloomberg Green. Catch it on TV, Quick Take, and online.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
They want to start buying equities or, putting on cheerleader outfits. I'm not sure that the Fed's going to stand by.
There are consequences of the Fed's asset purchases. The banking system is essentially awash in reserves.
What is most important for markets and the Fed right now is the labor market data.
Having some cash to deploy and look opportunistically for sellouts is a good idea.
Growth expectations are coming off, and this is what we need to be attuned to heading into the second half of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowitz. I'm Jonathan Ferro, together this morning with Katie Lyons, Tom Keene, taking a long weekend. We'll rub that in through the show, Lisa, for sure. Equity futures down 32 on the S&P 500. We declined by about 0.7%. Front and center, one single name. It's a tech heavyweight, Lisa. It's Amazon.
And it's about the projection going forward. It was disappointing. The expectation for the pandemic boom perhaps softening a little bit as people actually do other things other than just simply stay at home and shop online. You do wonder how significant this is given the weighting of a behemoth like Amazon.
Here's the line from the CFO. I would count on wage pressure for the immediate future. Let's wrap up the story over the last couple of weeks, Lisa. How many other CFOs, CEOs are in the C-suite right now thinking about the same thing?
Quite a few, and actually Amazon's very much a leader because they set the tone. Other companies have to compete in order to get workers. And just to give you a sense of how quickly they are hiring, they increased their labor force by 52% in the past year to well over 1 million people. So just giving you a sense of their clout in the labor market, John.
And their clout, of course, in these benchmarks. Kaylee, it's 4% of the S&P 500. It's 8% of the NASDAQ 100. To some extent, it explains why we're down today and down by 0.75%.
Yeah, dragging hard on NASDAQ futures this morning, John. But really what we're seeing with Amazon speaks to a theme, I think, broadly across big tech, this idea that growth has peaked and this pace of growth cannot be sustained. And what is that going to mean for some of these high growth names going forward? We had been seeing a rotation back into them, this market getting a little bit more defensive. And I wonder if that starts to change given the results we're seeing out of the likes of Amazon, John.
NASDAQ 100 futures down by more than 1%. Let's whip through the price action and get you up to speed this Friday morning. Good morning. Outside of Amazon and the equity market, it feels like a summer Friday. Let's hope it stays that way. It's nice and quiet. Euro dollar 118.94. We're unchanged. Yields are higher by a couple of basis points through the week and down on the week now, Lisa, by a couple of basis points. 124.56 in at around 125. Euro dollar 118.94. Unchanged. Lisa, it just feels unchanged outside of the equity market.
When you were saying that it feels like a summer Friday outside of Amazon, I could picture Tom Keene going,
Making
and I was
noises.
thinking,
Can we go without those noises today? Can we just get through 3 hours without them?
I literally heard it in my head, even though it was not happening. So I don't know what that says about me or my sleep deficit. I will say, coming up, we do have some really interesting economic indicators coming up. 8:30 a.m. we get U.S. June PCE. This is the key inflation metric the Federal Reserve looks at. However, it may be the least important of all the data that comes out. We also get personal income and spending data, as well as the expenditure data, basically the salaries that people are getting paid. It might give some indication of how much things are pressuring companies to lift wages with respect to these labor shortages, forcing them to pay up to get workers. Then 10 a.m. you get the U.S. July University of Michigan sentiment. The idea here is how much are we going to see a deterioration from increased inflation expectations? This has continued to be a theme. We haven't seen it that greatly in the past few readings. However, this is where people are looking to see how much this is dragging on people's confidence in the economic outlook ahead. And then at 8:30 p.m., the Fed's Lael Brainard is going to speak on rebuilding the post-pandemic economy. To me, this actually takes on new significance because this week, Fed Chair Jay Powell indicated that in some of the speeches that we're going to be hearing from individual Fed officials, we're going to be getting guidance on how they plan to potentially taper, on how they potentially plan to think about substantial further progress when it comes to the labor market. So, John, I actually think that some of these speeches may actually be informative.
I actually thought you were going to call her Fed Chair Lael Brainard there, Lisa, which is a separate story. That's something else.
I luckily did not.
She's part of that conversation, of course,
Yes,
which is
she
why I
is.
mentioned that.
Yeah. Well, she is actually one of the key contenders should Fed Chair Jay Powell not keep his seat. So her comments will take on even that much more significance given that backdrop.
Lisa, thank you. 127.63 is where we closed out last week on 10-year Treasury yields. So yields actually lower on the week now and on the session. 124.56 on 10s this Friday. We're down a couple of basis points this morning. I want to bring in Jay Bryson, Wells Fargo chief economist. Jay, let's talk about the data we've seen through the week so far in the U.S. economy. The wrong kind of surprises. Downside on GDP, upside on initial jobless claims. The supply side constraints that still persist. How much longer will they persist, Jay?
No, John, I think you're looking for maybe a few more months here. I mean, I think we've got to get some visibility around COVID. Are the kids going to go back to school in the fall? That's a crucial question here. And so, if they don't, I think you're going to continue to see some labor market constraints there. So I think this story is going to be with us for the next few months until we get some more visibility of what's happening here to the Delta variant.
Jay, in about 2.5 hours, we're going to be getting a slew of economic data, and a number of economists have said it's starting to get a little bit cleaner with respect to year-over-year comparisons, with particular emphasis on the employment cost index. Do you think this may be a good indication of how much wages are starting to pressure themselves up?
Yeah, I think so. Now, keep in mind, this is for the second quarter still. So the year-over-year comparisons are still going to be a little bit distorted there. But, as we go forward, not only with the employment cost index, but, as we see average hourly earnings next Friday with the labor market report there, we'll really start to get some sense on a sequential basis what's happening to wages here. And I would expect that at least in the near term, you're going to continue to see some upward pressure there, as you were pointing out earlier, as businesses continue to have to pay up for workers here. I think you're going to continue to see that on a sequential basis through some acceleration in wages.
Jay, aside from just the wage side of the equation, is the recovery in the labor market, just in terms of payrolls, of initial jobless claims, going to get a lot bumpier from here because of the Delta variant?
That's a good question. When we look at the July number coming out next Friday, I don't think you're going to necessarily see it right there, right? Because this was in mid-July and the thing hadn't really accelerated too much. But as we go forward here, I think you potentially could see some more bumpiness. The part of the labor market that still remains weak here is in leisure and hospitality. So we're talking restaurants, we're talking hotels, things that really got shut down. And if people start to spook and not travel, not go to restaurants, you could potentially see some pullback pullback in hiring in those places that have really boosted employment over the last few months.
Jay, my mind's already on next Friday. Lisa, 925 is what we're looking for. 925 is the median estimate in our survey from 850 in a previous month.
And the reason why this particular labor reading is going to be that much more important is because Fed Chair Jay Powell indicated, John, that this is where we're going to get is some sort of indication of substantial further progress. So in other words, should we get a massive market reaction if the number is a big beat?
Well, let's talk about the timeline. This is all about policy, Jay. How this Federal Reserve will respond to the incoming economic data. In the statement, they used the word meetings, plural. Is this several months of data they need to make some decision now on tapering?
Yeah, John, I think so. But I think the first thing you're going to do is, so that was a hint, on the FOMC statement. I think you may see some more further hints as we go forward. It could potentially be at Jackson Hole next month when Powell speaks there. It could potentially be the September FOMC. But I really don't expect to see a formal announcement of a tapering until later this year. November FOMC, maybe December, things of that nature. So I think although they are starting to hint in that direction, until we actually see the tapering begin, I think we're looking at least later this year or arguably early next year before it begins.
Jay, the details matter in terms of the path of tapering and what that means for rate hikes. Jay, there's a question of whether, for example, once they start tapering, this necessarily means rate hikes within, say, 12 months after that. How important is it, in your view, for the Fed to distinguish these two measures, to basically say we can be flexible in how quickly we taper the stimulus, as well as what that means for potential hikes down the line?
You know, Lisa, I think most market participants kind of understand the distinction there. And you know, if you go back, we've got an interesting playbook. You know, this is not the first time they've tapered. They did it, 8-9 years ago. And so they tapered all the way throughout 2014. They ended in 2014, but the first rate hike didn't occur until the end of 2015. So I still believe we're a long way away from that. And if you look at, they have another communication device called the dot plot. And, if you look at the dot plot, a majority of members don't think they're going to be raising rates before the